I'm Brad Smith alongside Rochelle Akufo. This is Yahoo Finance's flagship show, The Morning Brief, the ultimate guide to help investors make smarter decisions for their portfolio. We're tracking some early session volume here this morning and got your day's top stories and market themes and elevating Yahoo Finance's most popular newsletter.
That's right, Brad. We've got a packed show for you on this Wednesday morning. Futures recovering some of their losses following a big sell-off stemming from January's CPI print, which showed prices rising more than the street anticipated. All three major indices on Tuesday closed down more than 1% on the heels of that report.
That's right. And investors are digesting the latest round of corporate earnings from Lyft, Airbnb, Robinhood, and Instacart. We'll break down what these quarterly results could mean for the market's momentum. So let's get right to it with the three things you need to know, your roadmap for the trading day. Yahoo Finance's Josh Schaefer, Dan Halley, and Jared Blickreed have more.
Hey Brad, futures edging higher, rebounding slightly from Tuesday's sell-off following a hotter than expected inflation report which showed January prices rising more than forecasts anticipated. The Dow closing down more than 500 points, the index's worst day since March of 2023. The S&P 500 and Nasdaq each ending the session off more than 1%. The sticky inflation report indicating the Federal Reserve may start cutting interest rates later than expected this year and further fueling that debate on when those cuts will come.
We're also watching shares of Lyft this morning, a typo in the rideshare company's fourth quarter earnings release, sending Lyft up more than 60% in extended trading. Initially, Lyft forecasted a 500 basis point expansion of its adjusted earnings margin for the full year. The company later clarifying the number should have read 50 basis points, reversing the stock's course. Shares now up around 21%.
And Airbnb shares there slipping in pre-market trading. The online rental marketplace reporting an adjusted loss per share of 55 cents. That's narrower than street expectations of 68 cents a share. And the company also beat street's revenue expectations while suggesting there could be more moderation in demand going forward. On Airbnb earning call, Chief Executive Officer Brian Chesky said he remains optimistic about the company's growth and expansion into international markets.
Well, good morning and a happy Valentine's Day to everyone. Didn't want to go any longer without them wondering, are they going to say the thing? Are they going to say the thing? Happy Valentine's Day, everyone. Happy Valentine's Day, Rochelle. This morning, the moves in the market we've seen over the last 24 hours, certainly in focus as stock futures. Right now, we're tracking the Dow, the S&P 500, and the Nasdaq for you this morning. They are bouncing back after yesterday's deep decline that we saw. The sell-off on January's CPI print showing prices increasing more than the street expected here. And there you're taking a look at some of the futures activity, but for the Dow and where we ultimately saw things slip up yesterday, it is a cleanup story here this morning that we're trying to see be initiated by some investors, but a larger question. I think this places a lot of focus on what this means for a Fed and a much longer, higher for longer perhaps, rate pathway that they have right now.
It's true. I mean, a lot of us already knew that perhaps a March rate cut off the table, but now pushing it back to perhaps beyond May as well. So really consolidating some of those rate cuts that we might see in the back half of the year, that little bit more breathing room that the Fed now has. I was surprised that the market sold off that much, though, because I think the Fed has telegraphed that it's going to be taking it month by month and not having these sort of knee-jerk reactions to the data. So then to see the markets react in this way after the Fed has consistently said, we've not beaten inflation, sort of take a breather here, but markets determined really not to listen here and paying the price for it.
Yeah, and we heard that from a lot of our guests yesterday as well. We actually got some commentary out from Rick Reeder, BlackRock's chief investment officer, via email yesterday. And in reaction to a lot of the CPI report, markets continuing, of course, to focus actively on the CPI report. And while the news on inflation, he says, is increasingly one of no news is good news, today's data did come in firmer than many expected here. So really kind of mirroring and echoing what we had heard on the whole, and overall they believe that the trend in inflation is broadly heading in the right direction relative to the Fed's inflation targets. Today's data appears to be a little bit of a setback, he said, on that announcement. Well, futures steadying this morning, as we mentioned, after a hotter than expected CPI report sparked a market sell-off Tuesday, but our next guest thinks it might be the time to buy the dip. Max Kettner, HSBC Chief Multi-Asset Strategist, is here to break it down. Max, great to speak with you here on the day. All right, so for all of the people that are going to be all ears to where they should be buying into this dip right now, where are some of the hot spots from your purview?
Yeah, look, good morning, and thanks for having me. I guess, tactically, we're still a bit more cautious, right? So I think there's still a bit more of a basis for some what we call reverse Goldilocks. Not quite the time to buy the dip yet. I think longer term, right, if we're looking sort of 12, 18, 24 months out, certainly we would be still on the more optimistic side for equities in particular. But for the very near term, I think you've simply seen a little bit too much optimism around the whole inflation and disinflation story. A little bit what you guys were just talking about. The market is paying the price right now for a bit of the froth right now. So we're waiting for some of that froth to be taken off and some of those spaces of the market. In particular, I would say when we look at positioning of so-called systematic investors, so those ones that are they're following more mechanical the rules. So something like volatility target-based investors, or something like risk parity-based investors, right? People that, or strategies that are really using volatility as an input. And of course, as volatility went down in the last couple of weeks, those kind of strategies have really bought into the market. But now the positioning of those so-called systematic investors is very, very long in equities. So we're really trying to figure out, okay, once they're a bit less long the market, really a little bit less exposed to equities, then it's probably time to buy the dip. Not quite yet, right? Because particularly among those systematic strategies, we're still seeing a little bit too much froth.
So then you mentioned the term reverse Goldilocks, which some viewers may not be familiar with. What is that, and what are the sort of shocks to the system that a reverse Goldilocks can really play out here?
Yeah, I guess, we can simply call it good news becoming bad news, right? It's a little bit what we've seen yesterday, and it's a little bit also what we've seen in the data in the last couple of weeks, right? Let's see what the retail sales and production numbers bring tomorrow. But obviously, we're now more and more in an environment where hotter than expected activity data actually sends yields up, right? So bonds selling off, and as a reaction for higher yields, that also sends equities and other risk assets down, right? So it's a little bit the opposite, the reverse of what we've seen in November and December, where yields were down, so bonds were gaining, and in conjunction with that, almost everything went up, right? Whether there was bonds gaining, whether there was high yield, whether there was emerging market assets, whether there was equities, it didn't really matter where you were invested, right? As long as you were invested in any sort of asset, everything was swept higher. So reverse Goldilocks for us is then the opposite, right? Then with higher yields, with hotter than expected data, which effectively should be good for equities, right? But with hotter than expected data, that sort of sends yields a bit higher. And with higher yields, that sends a bit of pain across the asset classes. But just to be very clear, that to us is a temporary phenomenon, because at the end of the day, we're only then seeing those temporary sell-offs because things are too strong, not because suddenly we're sort of joining the doomsday camp, right? It's because it's too strong, because activity is actually surprising so strongly to the upside. So that means any kind of really meaningful dip is then to be bought in risk assets.
Max, the IMF World Economic Outlook projects global growth to stay at 3.1% in 2024, rise to 3.2% in 2025. What type of real and meaningful global reacceleration are you anticipating for this year, and how do you price that into your portfolio strategy?
Yeah, look, I guess particularly near term, both earnings expectations and actually GDP growth expectations, particularly for the US, are still very, very low, right? We're just starting now that consensus expectations are again being upgraded as the data sort of trickles in for Q1. So we started Q1 growth expectations and Q2 growth expectations just a couple of weeks ago at 0.4% each, right? Remember, that is annualized. So we're talking about consensus expected at the start of this year, 10 basis points of growth, right? So almost close to 0% growth for the US. Clearly, US growth momentum is much, much hotter. To the point, or to your question, really, we don't need to see growth blowing out to 5% or something, such as it did in the third quarter last year. It is already enough if growth is a little bit better than expected. Because if we have such low growth expectations, right, where it's close to zero growth expectations, it really doesn't need a lot to have a bit of more positive activity surprises And as as long as those kind of low growth expectations, low earnings expectations in the near term, as long as that continues, it's going to be really, really easy for US activity, right, for all the activity data to surprise positively. And that ultimately is good for equities and other risk assets.
I know we'll continue to track that story. Appreciate you taking the time to join us this morning. Max Kettner, HSBC Chief Multi-Asset Strategist. Thanks so much. Well, also watching Lyft shares higher in pre-market trading, but of course they've pulled back significantly after soaring more than 60% on a clerical error. The ride-hailing company's original release stated it was expecting profit margins to expand 500 basis points before correcting this to 50 basis points during its earnings call, saying this was a clerical error. Well, for more on these results, we're joined by Dan Ives, Wedbush Securities Managing Director and Senior Equity Analyst. Good to have you on, Dan. So in terms of your reaction to this accidental typo and the reaction that we saw in the markets here, I know you've had some choice words about an error like this. Clearly, it has to pass through a lot of hands. A lot of eyes get to see these things before it goes out. What does this signal to you?
Look, this was a Ted Stryker airplane moment. I mean, if you look at this, it's a black eye for Lyft. And even though these were good numbers and a step in the right direction, look, this has really been a comedy show the last few years. And it's just another, I think, credibility issue, that we've seen. Again, just a shock and never seen anything like it 25 years.
Does that credibility issue impact the invest worthiness of Lyft from your perspective, Dan?
I mean, if a pilot lands in the wrong airplane and he lands and then all of a sudden he lands in the wrong destination, do you question that team? I mean, that's the fundamental issue. And then at the same point, you have Uber, just another flex the muscles moment. Look at what's happening there. I mean, now obviously a buyback. Lyft continues to be the little brother of Uber.
And so, Dan, with that in mind, obviously Lyft still pushing back on expanding in the way that Uber has in terms of expanding its services, staying this pure play. What do you think is going to be the key then to become perhaps a bigger brother than it already is, especially when you look at things like some of the partnerships it has?
Yeah, I mean, look, partnerships. I mean, you look at autonomous, you look at some expansion into some other areas, but the fundamental problem is that they have to expand margins. Obviously not 500 bips, 50 bips. I mean, it definitely feels like they're in that direction. They got to prove it. This can't just be a one step forward, two steps back. They have to execute. It definitely was a step. But look, this is also overshadowed by almost a historical error, in terms of what we saw. So this is going to be another prove me. But at least for now, they're going to be at the little kids' table at Thanksgiving.
And so all of these things considered, I mean, we're taking a look at some of the moves here over a more extended period of time. As you kind of consider the outlook and how consumers are continuing to engage with both of these companies, is there anything that you can extrapolate from one about how they're engaging differently with this current consumer and retaining market share as well as perhaps stealing some away?
Yeah, Brett, I think Uber has actually been gaining market share, peak rides, gaining market share from a driver perspective, profitability increasing. I mean, it's a clinic. This has been a comeback story. Obviously, Zuckerberg and Meta comeback story for the ages, but this is kind of 1A. If you look at what they've done. Lyft, confined, right? Domestic. You don't have food delivery. So there's just not that many levers they can pull, and you guys show profitability. They've had a lot of, turnaround in terms of changes from management team. And now you have we'll call it a clerical error for the ages.
And Dan, they do still have forecasts of better than expected bookings. They expect to be cash flow positive in 2024. What is the base case that's going to get them there?
Well, I think it's more profitability, but, you're starting to see some cuts that they've done pay off. Promotions. Ride sharing overall has been a massive tailwind. We've seen that with Uber. But this can't just be the boy that cried wolf, right? In other words, you need to actually execute. And that's been the issue here. One step forward, two steps back. So investors, you'll see obviously, strong move today, which they deserve, but to really start to see long-term traction, they have to execute. And they're in the shadow of Uber with another Mahomes-like performance. And now a buyback that they just announced.
Yeah, exactly. And so, Dan, for Lyft, I mean, David Risher, he's been in this role for less than a year at this point. How much time, how much of the turnaround strategy do you think investors are going to be continuing to kind of give that leeway, that ultimate amount of time for them to see a turnaround?
Yeah, I think by the end of 24, if not then the alarm bells ring, right? And I think, look, he's done a good job coming out of the gate, but you have a year here. But also, it's our view, we're in the midst of a new tech bull market that we see going on through the end of 2025. So Lyft's sitting there in a minivan going 35 miles in the right lane. And then the left lane, you have, not just Uber, but the rest of tech, led by AI, godfather of AI, Jensen, NVIDIA, and others. So I think that's the issue, is that, there's time is not endless here.
Dan, just quickly, what does Lyft need to do to make sure that they don't miss out on that next tech bull market?
Well, I mean, look, they've already made a lot of strategic mistakes. I think right now they have to expand from food delivery. They have to go after autonomous partnerships, strategic, a lot of options on the table here, but you can't have hubris.
Dan, great to speak with you as always. Thanks so much for joining us this morning. Good to see you. Dan Ives, Wedbush Managing Director over there, talking all things Uber and Lyft with us here this morning. Stay tuned for our 3 to 5 p.m. show today. Josh Lipton's going to speak with the Lyft CEO, David Risher. You do not want to miss that. Well, Airbnb shares slipping in pre-market trading after reporting mixed fourth quarter results and suggesting there could be some moderation in the number of nights and experiences booked. Let's get to our top takeaways from the report here. As we're taking a look at shares pre-market, they are down by about 3.7%. I think for me, one of the huge things that kind of jumped out was ultimately on the side of the ADR, this average daily rate. And, one of the things that Akiko, who's going to be covering this as well during the 11 a.m. hour, I believe, one of the huge things that jumped out to both of us as we were slacking yesterday was just about where this continues to moderate. And so if this stalls, is that more indication of us to the amount of supply that's entered into this market for Airbnb listings in more urban, more city centers that had actually brought down a lot of that average daily rate? Or does this mean that now you have more of the non-urban or suburban or even kind of countryside and the, rent and stay here and you get your golf cart or something like that type of places that bring up that average? And are we going to see more of those continue to list as well? So that's one thing that it's really going to be interesting to track from this point forward. But that was one area that investors were keeping tabs on, and some of the slippage that we had seen late last year as well.
It's true, because they did talk about that need of having, the right product in the right place at the right time for big events and things like that. And obviously there was a lot of backlash when people complained about the fees, especially the cleaning fees, talked about walking back a lot of that and seeing a lot more inventory coming to the market. And so with that in mind, the thing I'm focusing on is Q4 supply growth growing 18% year over year. We saw in the earnings call, they called that a real highlight, adding nearly 1.2 million active listings over the last year. And it was that thing again about timing. They saw the highest growth in regions with the highest demand. And they also talked about the majority of these new listings being exclusive to Airbnb. And I know there's been a lot of pushback about, people having perhaps second houses, using them as Airbnbs, what that's doing for house prices, and really constraining the supply of perhaps first-time home buyers. But at least for now, Airbnb is seeming to have that network effect, and it's really feeding into itself. Indeed. We're going to continue to track shares of ABNB as we get closer to the start of today's trading activity. Also, we got to talk about Instacart here this morning. Instacart, it's a hit on the back of its fourth quarter earnings that you're seeing priced into shares right now. We've got Yahoo Finance's top trending tickers coming up next.
Let's take a look at one trending ticker that we're watching this morning. Shares of CART, C-A-R-T, down by about 6.5%. Instacart shares sinking after announcing a restructuring during its fourth quarter report, which will impact 250 employees. It's roughly 7% of its workforce. Instacart shares are down over 15% since its public debut in September. There you're taking a look at that max chart. It's actually about 17%, and we'll see exactly where things open up here on the day. One of the huge things that they had talked about within this report is just the year that they're coming off of, talking about 2023 as a transformational year for Instacart, expanding lead in selection and quality, making the service faster with some of the prioritization there. But most notably here, as we mentioned off the top here, that restructuring plan impacting 250 of their talented team members, they say. They also talked about this additional $500 million for share repurchases. So kind of, putting the layoffs up against the share repurchase plan here, that's something that brings the total buyback plan to $1 billion.
And it's tough. I mean, when you look at the layoff picture and you look at rising competition in this space, you see a lot more overlap. You're seeing a lot of companies either providing their own sort of services here. And when you look at the fees that are included, and you have a consumer who's trying to pinch their pennies, and then, of course, food inflation. A lot of the products that people are getting via Instacart, it's their groceries. These are still very expensive. Inflation is still biting there, although we have seen some of that moderating here, but all of that really contributing to some of that profit falling last quarter. Also want to switch gears to another trending ticker that we're watching, Sony, pulling back on expectations for gaming, saying it now expects 4-year sales of only 21 million PlayStation 5 units, down from its previous forecast of 25 million units. The company also slashing its sales outlook for its gaming division as a whole. Now, this is interesting because I know we've been talking a lot about these different gaming tie-ups, and you would think Sony was well positioned. So I'm not sure if it was more of a pricing issue on the consumer side, or that a lot of people weren't ready for that sort of upgrade, especially given how much they've already paid for the previous iteration.
Yeah, this was a really difficult cycle, it sounded like. The cost reduction within the cycle, difficult to come by, they mentioned, and they just frankly said on the call, for gaming this year, profit margin, especially the operating margin, was not really a wonderful situation. And so, well, partly because they're currently in a transition where the PS5, that PlayStation 5, as a hardware unit is expanding as a process, but what they need to manage is the PS4 and the previous generals. So unlike previous generations they talk about, if you look at the console cycle, cost reduction within the cycle, very difficult to come by. So it really is where that's impacting margins, where they're trying to get through some of that inventory as well, it seems like, during this most recent quarter.
It's true, and we saw the Senior Vice President, Naomi Matsuoka, saying, looking ahead, PS5 will enter the latter stage of its life cycle. So we'll see if that timing aligns perhaps for the next quarter or two to see if that ends up panning out.
Yeah.
All right, well, coming up, we've got the opening bell on Wall Street. Don't go anywhere. Time for today's stock to watch. We're watching Kraft Heinz sales falling over 7% from a year ago as volume failed to outweigh price increases. Yahoo Finance's Madison Mills is on the floor of the New York Stock Exchange with those details. Hey, Maddie.
Hey, Rochelle. So this is a stock to watch today because we are looking at the pricing power dynamic when it comes to Kraft Heinz, and it looks like they don't have it anymore. And this is a repeated story that we've heard from some of the other consumer staples and consumer-facing snack and food names in that space. I think about a Mondelez, a PepsiCo, saying that their volumes were not going up at the rate that they thought they would, and that they anticipated would match up with those price hikes as well. So just to run through some of the numbers for Kraft Heinz here, the sales down 7%, prices up 3.7 percentage points, and volume down over 4 percentage points. So again, that disconnect between the volume and the price increases, that is going to weigh on margins. Now, having said that, I was really interested in these Kraft earnings because you tend to think of this as a name that does well when consumers are trading down, right? You've got your soups, your sauces, some of the more affordable items for consumers, but they were dinged on two fronts. One, SNAP benefits had a change. That's why we've seen 3 quarters of misses for Kraft Heinz. They're going to have to figure that out moving forward, and that is going to continue to weigh on the stock. That's our second point this morning, because if they have to increase promotions, if they have to decrease prices on some of these goods, that's going to continue to weigh on margins moving forward. And we know that the street loves to look at forward guidance for these names. The forward guidance for Kraft not painting a good picture for them. Now, having said that, I was interested to compare this to the earnings that we saw from Procter & Gamble earlier on this earnings cycle. This is the name where you can think about your Charmin, toilet paper, some of your other staple goods. P&G saying that they were able to hold up on their pricing power and that consumers were buckling to the price hikes that P&G put forward, that consumers were able to keep up with those prices rather. So that indicates to me that consumers might be saying, okay, we've got to spend on staples, but we're going to continue to trade down when it comes to food. And that makes sense given the CPI print that we saw yesterday, where food prices continuing to go up and up and up. That might be an indication that consumers are going to some of those store brand names that are the cheapest and most affordable option for them.
All right, Maddie, stand by. We're going to be coming back to you in just a little bit and digging deeper into Kraft Heinz' latest results later this morning with Morningstar Director of Consumer Sector Equity Research, Aaron Lashby. Be sure to stick around for that conversation. We're just seconds away from the opening bell, and here it is right now. So let's go right to it. We've got a live shot of the New York Stock Exchange where New York Cares is ringing the opening bell. And in Midtown Manhattan, looks like you've got Phibro Biologics. That one won't get tricky ever. Taking a look at the opening bell, they've got some funfetti, so we're happy for them. Taking a look at the opening bell here as we see things start to open up. The Dow and the S&P 500 open higher. The Dow coming off of what was nearly its worst day in nearly a year, basically. As we're taking a look at the Nasdaq, that's calibrating here on the morning, as we'll get that updated for you. There we go, right on cue. It's up by about 0.8%. So fractional gains to start off today's trading activity. We've got Jared Blickreed standing by at the Wi-Fi Interactive. Fitting, Jared, that we're going to you first here today because you've got some of the overall international moves and some of what is teeing up today's trading activity as well.
You bet, Brad. And I think everybody's just reeling, trying to take stock of what happened yesterday. Nice to see some green on the screen here. I'm going to pull up the Russell 2000, and let me just show the 2-day view. It's up over 1.5% today, 1.62%, still down 2.5% over the last few days. It was the worst day the Russell had since the middle of 2022. Worst day, as you said, in the Dow for a year. So really just trying to figure out, is this a one-off or is there more substantial selling in the future potentially going on? This is a 10-year T-note yield. This is the biggest chart, most important chart I'm watching right now. This is a 3-month chart. Let me put a 6-month with some lines so you can see what I'm about to draw. We came down from above 5% or just around 5%, and we have made a double bottom here, and a simple measured move points to 4.5% as a target, a potential target for the 10-year. Why does this matter? That's because markets may be readjusting to what they believe is a new normal. normal. The potential for a Fed no landing, that is a reacceleration of inflation, which we saw perhaps the beginning of yesterday. That's a possibility as well. Here's the U.S. dollar index. This broke heavily to the upside. U.S. dollar weighs on equities, weighs on commodities, and we have it heading higher here. And as you can see, the next logical target is probably quite a bit higher than where it is now. All of this can continue to pressure stocks. I'd also mention that February is historically a weak month. I'm not going to get into all the details in the seasonal maps here, but suffice to say, this is where we would expect some weakness. But looking at the board today, we get a little bit of a reprieve from
Indeed.
that.
What a difference a session makes. We'll see if that holds. And of course, we have Yahoo Finance's Madison Mills on the floor of the New York Stock Exchange with Jay Woods, Freedom Capital Markets Chief Global Strategist. So, Madison, what are you hearing around the exchange this morning?
I mean, it's a good morning, Rochelle. A little Valentine's Day gift for markets after yesterday's sea of red on the screen. But I want to talk to you, Jay, about this because I'm curious whether this means that the market has fully moved past some of the bad news from yesterday.
Well, this reminds me of the last FOMC meeting where we sold off 1.5% after Powell spoke. Yesterday, this number came in a little hotter than anticipated, and the knee-jerk reaction was to sell off. But seeing where we've come from, up 14 out of 15 weeks, no 2% retracement from the high in over 75 trading days, a pullback was coming. I thought it could extend a little bit into today. The market is very resilient. I'm watching the Russell. That hit its 50-day moving average and held. So maybe we avoided a disaster, but I think down and sideways is where we're going to be going for the next few weeks.
So what is this resilience based on?
Well, it's more of a broadening out. Everyone talks about the mega caps having their run and lifting the indices on their shoulders. Well, we're seeing leadership in industrials, seeing it in financials minus the regional banks, and we're also seeing it in healthcare. Those three sectors make up 49% of the Russell 2000, and that is why the Russell has remained neutral to up. We want to see the Russell get above 2,000. It's teetering there as we speak. But right now, I think after that meeting, we're going to go sideways. We're going to watch jobless claims numbers every Thursday. We want to see how that's, if unemployment is ticking up. Those are things we'll watch. But I think between now and the next FOMC meetings, the highs in this market may be in. And if we pull back a little bit, it'll be a normal pullback. There's no fear in this market. And people were getting slightly nervous yesterday. I think that's kind of subsided for now.
So here at NYSE, something very cool that happens is you can buy a record-breaking S&P hat, the S&P 5000 hats, right? When is the next time that you're going to be able to put in an order for a record-breaking hat?
Well, record-breaking hat, I don't know when that's coming. I would probably think after the next FOMC meeting, let's see, in March. But I can get you a hat if you want one of those S&P 5000.
You know I want one.
All right, and Brad, I'll see what I can do. But yeah, this has been a crazy rally going back to October. We're pulling back, we're digesting. Seasonally, we're in a weaker spot. So I don't think that we're alarmed by a slightly hotter than expected CPI. The direction of inflation is still cooling. Is it this soft landing everyone anticipated? No, it's a little bumpy. You get on a plane, you're going to hit some turbulence, and I think we're hitting some turbulence now. We'll see what the PCE says. As Powell says, boring. I know, one data point at a time. But overall, the trajectory is good. Earnings season was successful, and we still have a few ones that we're watching going forward. NVIDIA next week. My God, that's going to be big.
Big week to come next week on that, Jay. Thank you so much. Really appreciate it. Brad and Rochelle, back to you in the studio.
All right, I'm going to be standing by. I'm going to hold them to that hat. Maddie, you let him know. It's going to be in the rotation right next to my Sixers hat and my Eastside Golf hat. Jay Woods, Freedom Capital Markets Chief Global Strategist, and Maddie Mills down there on the floor of the NYSE. Stocks moving higher this morning after a massive sell-off hit the markets this week. Just Tuesday, a hotter than expected CPI report pushing investors to rethink their rate cut bets. For more on why that matters in the areas of the market that could continue getting hit, we've got Yahoo Finance's very own Josh Schaefer here with us. Josh, what have we kind of dug into from yesterday in the areas of the market that could continue to be under pressure?
Yeah, Brad, I was just taking a look at overall Fed bets yesterday, right? It's always one of our favorite things to watch. You look at that CME Fed Watch tool. You can look at the world interest rate probability on something like the Bloomberg terminal and sort of track some of these things. And what stood out to me is we're now at a place where we're basically pricing in 4 cuts. And if you guys remember this line here, we got a couple lines in there now, so it's getting a little busy on us. But we're looking at that yellow line is 213, that's yesterday. And two things I'd point out is the yellow line is significantly lower than the light blue line. That was October, that was before our fall rally, right? That was when we didn't think the Fed was gonna cut that much next year, but it is significantly above the pink line, which was sort of peak dovishness. That was the soft landing euphoria that we had. So we're finding ourselves somewhere in the middle, and it seems like overall market participants are relatively comfortable with that.
Yeah.
That's okay because we're at least not back to, are we even gonna cut? I think people are starting to wonder if inflation's reaccelerating, but not necessarily that worried about it. And then you turn and sort of take that chart and you say, okay, what's up, what's down, right? And we've noticed yesterday, you look at something like the Russell 2000, which had been rallying over the last couple of days, took a serious hit. You can track that with something like IWM. And then you take a look at real estate, one of the top sectors over the past couple of weeks, that also got crushed. So people essentially saying, okay, if we're gonna see interest rates higher for longer, what areas is that gonna impact? And that's where people sold.
It's true. And then, of course, we're going to continue to get a lot of Fed speak out this week. Austin Goolsbee already saying, if we stay restrictive too long, we'll have to worry about the employment side of our mandate. So we knew that was going to be a balancing act, even though we saw some of a reprieve in terms of wage pressures. But what do you think markets are going to make of that, given the strong reaction that we saw to the CPI report?
Yeah, I mean, right now it feels like we are in a good spot, and this is what a lot of economists were saying in reaction to the report yesterday is, okay, one CPI print didn't come in how we wanted it to, but let's not forget that the economy is still doing well, right? So even if we did, we ruled out March yesterday, right? If we're still talking about what people want for Fed cuts. March is pretty much out of the table. Bank of America said that. It was a nice note. They said March is gone. May could still be in play. That sort of depends on what you get from inflation. But we might have enough strength in the economy right now to last until June, right? And that's sort of what Goolsbee's talking about is, can we make it until June if we need to without having a 50 basis point cut because something in the labor market breaks? That is, I think, Rochelle, yes, still the fear and something people are going to be talking about more.
Absolutely. We're going to continue to monitor those comments out from Austin Goolsbee, the President and Chief Executive Officer, as well of the Federal Reserve Bank of Chicago. He's in a moderated Q&A at the Council on Foreign Relations today here. We've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Shares of Airbnb are down about 5% after a mixed fourth quarter report. The company also signaling a potential moderation in demand. Joining us now, we've got Jed Kelly, Oppenheimer Managing Director of Equity Research for the consumer market or consumer internet here. Jed, great to have you here with us right now. I want to get your read in on this report and the tenor that you took away from the call last night.
Yeah, I mean, the report was mixed. Obviously, the market doesn't like that we had another quarter of decelerating room nights, and they're guiding for they're guiding for 1Q to decelerate, right? So the issue you have is the stock still trades at a premium multiple, a low 20s EV to EBITDA, and you have room nights, you have 1Q room nights in the high single digits, probably around where the street's shaking out is around 9% growth for the first quarter. Now, room nights should reaccelerate slightly because the comps do ease. However, it's still not what you're looking for for people to get excited given where the stock is trading right now.
And we know that they did highlight things like their Q4 supply growth growing 18% year over year. How much of that can they really hang their hat on? I know they also talked about expanding internationally beyond sort of their core market here.
Yeah, no, the supply growth is great. I mean, they're growing over 18%. I think a lot of fear was in 22 that everyone thought they were able to accelerate supply from the COVID uplift. So supply is great. But the question I think a lot of investors are having is typically demand and supply usually converge, and supply is a good read through for future demand, but it's not happening right now. So it kind of makes you question what's the incremental sell-through rate of the inventory. Are they adding more quality rooms, right? And I think some of the fear among investors is as they're getting into more urban areas or travelers are returning to more urban areas, that inventory is not converting. And then to your other point on international expansion, they are expanding into more areas. However, that inventory doesn't look to be converting as well either. That could just be travelers in those areas still aren't comfortable on the Airbnb platform, and there needs to be some consumer education.
And so in bookings, with more urban area kind of listings and hosts, how does that trickle through to the average daily rate, which we've seen kind of stall out here?
Yeah, the mix shift to urban typically carries a lower ADR than your, 3-bedroom vacation home in the Outer Banks. So the mix shift to more international markets and more urban generally would cause ADRs to go down. However, on a like-for-like basis, ADRs are still hanging in there. I mean, Airbnb is introducing more tools for hosts to drive value, increase conversion. However, ADRs are remaining pretty sticky right now.
And Jed, I want to also put this in context of the one-time tax charge that was also included in these numbers. When you look at that in terms of the overall fundamentals, then when you're looking at the numbers, then how should we really gauge the health of this business?
Well, the business is very healthy. I mean, this was a one-time tax charge that, they're going to have to pay. But when you look at their overall free cash flow, they're still going to generate well over $4 billion of free cash flow this year. I mean, from a free cash flow position, right, the business is really healthy. It actually, on a valuation perspective or valuation basis, it trades at a favorable free cash flow yield relative to EV to EBITDA because they have positive working capital dynamics. So this was a one-time tax charge, doesn't indicate the health of the business. The business is healthy. I think the question for investors right now is we have decelerating room nights, but a premium valuation. So, what's the right entry point to get in given some of the top line KPIs?
Jed, just lastly, while we have you, we've been able to speak with a few C-suite members within the accommodation space over the course of this earnings season, and they're really looking at this rebound in corporate travel as that's going to flow through to margins. What, if you're thinking about Airbnb, what share of that do you think that they're going to be able to kind of capture as we're looking at that rebound?
They have a pretty low share of corporate travel. It's just easy for you to book a hotel when you're traveling to a city. I think what they have to do is start working with more companies, develop more partnerships to educate companies that, hey, an Airbnb can be a good option for your company to travel, right? I think right now where they benefit from corporate travel is more corporate retreats, right? You want to do you want to host, 25 of your top salespeople. Let's go get an Airbnb and you can work through that. But in terms of, your nuts and bolts business trip, they're very low percentage of that type of travel that's coming back.
That does make sense, given the sort of ecosystem, as you're mentioning, that they cater to. Appreciate you joining us, Jed Kelly, Oppenheimer Managing Director of Equity Research for the Consumer Internet. Thanks so much.
Thanks for having me.
All right, coming up, we'll be digging into the latest moves from Arm, the company continuing to move on that AI hype. That and more after the break.
ARM shares moving higher today. The company has seen positive momentum from generative AI demand following its Q4 earnings report. The CEO then saying they're seeing strong momentum and tailwinds on all things AI on the earnings call. Let's bring in John Vinh, KeyBank Capital Markets Equity Research Analyst, to get his insights. John, great to see you. First and foremost, just how long out are the markets looking? How far out as we think about where the company is even talking about the AI demand and the investors trying to assess what type of multiple they should give to this company?
Yeah, I think the broader investor community is typically looking at 3 to 5 years out on a company like ARM. You know, if you think about kind of the drivers for them in terms of AI, you know, they're certainly getting significant traction in cloud hyperscalers as they are increasingly moving to ARM architectures. However, you know, penetration rates right now of ARM versus x86 is still pretty nascent. But there's still definitely momentum. It's likely going to be a much more meaningful contributor for them, you know, 3 to 5 years out.
So, John, given that timeline, then, how much of the hype around AI or the sort of show and prove at this point has already been baked into ARM's valuation?
I think there's certainly, you a significant amount of premium that's baked into to ARM. It certainly trades at a pretty hefty premium to the group. It trades at between 40 to 50 times kind of 25 earnings at this point in time. The broader semiconductor group trades at a high teens multiple. But these guys certainly have a best-in-class operating model, licensing model, 90% gross margins. And we feel like over time, the market is increasingly moving towards them.
And so all that considered, when you kind of look at the different players within the space and kind of pair ARM against them, number one, does the revenue model that ARM has set up, is that set up adequately in order to make sure that they're capturing and monetizing fully the demand that is flowing their way on AI? And are they set to capture enough market share to kind of stave off or at least provide a baseline for investors to expect going forward?
Yeah, we certainly think so. If you think about kind of the ecosystem, I mean, they have hundreds of millions of developers who are developing products on ARM today. Obviously, not all of those products are being developed on, AI type of chips, but increasingly that's going to be one of their strongest assets that they have currently. And, their main competition right now is probably x86, right? The biggest incumbent there is Intel. And if you think about just the x86 architecture, it's really not optimized and levered and set up to benefit from this shift towards heterogeneous compute and generative AI.
And you have an overweight rating on the stock, price target of $120 here. You talked a little bit about the sort of where they fit in the generative AI space. Obviously, when you think of all companies involved, your NVIDIAs, you have your MSCI, sort of different ways to get into this space. What gives ARM their edge?
Yeah, their compute architecture is incredibly efficient and lower power. And power is increasingly becoming a greater issue within the data center. And that gives them a pretty significant advantage over x86 at this point.
At this point as well, you've got more capital flows that are going to be moving around, whether that's fundraises, and that's particularly interesting. Not a fundraise, but looking for more capital is OpenAI as well at this time. Where do you believe that kind of moves some of the sentiment around, even in this broader landscape here for generative AI opportunities?
Yeah, I mean, our favorite kind of AI plays are going to be, AMD, NVIDIA, Broadcom, Marvell, and Micron. Each of those companies has significant exposure to where we think the market's pointing with generative AI. Obviously, GPUs are going to be front and center next week with NVIDIA. AMD, obviously, we think has a very strong offering that's starting to ramp. But some of the other players also play well into that AI ecosystem as well and should benefit from this increased investment on Gen AI over the next 3 to 5 years.
And so as we look at some of that pricing, because Sam Altman sort of making the rounds here, looking to build this generative AI tech center as they've been restricted in terms of the supply of advanced chips. But then you have NVIDIA's CEO saying, look, the prices of some of these things are supposed to come down as this technology gets more advanced and it becomes more available. The price should come down. How should we be viewing really the trajectory from here of generative AI spending here?
I think it's going to remain strong for the next several years. Right now, as you know, just the whole market is supply constrained. Customers cannot get enough GPUs right now to supply their needs. Obviously, we think there's going to be a significant amount of industry capacity that's going to come online in the second half, but the demand is only going to be growing over the next several years.
We'll continue to watch that. Clearly an ongoing story that on the minds of all earnings season watchers as well. John Vinh, KeyBanc Capital Markets Equity Research Analyst. Thank you for your time this morning.
Thanks for having me.
All right, all your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
And Brad Smith alongside Rochelle Akufo. We are about 30 minutes into the start of the trading day. Let's take a look at how things are shaping up right now. Stocks are higher today following a deep sell-off Tuesday. The Dow had its worst day in about a year. Now things looking brighter for the market.
Indeed, but also taking a look at some individual trending tickers. Shares of Generac moving to the downside on the company's quarterly results. The company missing the street's estimates despite an uptick in demand for home standby generators. Generac also issuing downbeat guidance driven by weakness in its industrial and commercial business.
And another stock in the red today, Upstart. Shares falling as the company missed expectations for guidance. An analyst at JP Morgan calling the outlook a shock, saying they assumed the business was right-sized. Upstart's CFO warned about the current credit environment, saying that richer borrowers are seeing rising delinquencies.
And also watching shares of Zillow moving higher this morning. That's despite issuing softer Q1 EBITDA guidance on the online real estate giant, beating on the top and bottom line, as Zillow continues to navigate headwinds in the housing market.
And we're monitoring Bitcoin today. It's hovering just under $52,000 after briefly, and I do mean briefly, crossing that level earlier today. Just this week, the cryptocurrency topped 50,000 for the first time in over 2 years. Of course, a lot of things in focus here coming off of the Bitcoin ETF being able to move forward. And ultimately now all focus on where else within the crypto landscape we could see more ETFs, whether that be for Ethereum or for other cryptocurrencies, start to move forward or be applied for as well. But then also you think about the Bitcoin halving and what that could potentially do. We're also coming off of Robinhood earnings, which we'll dive into just a little bit later on, actually pretty imminently.
That this is true. I mean, Bitcoin's an interesting one because even though we do see a lot more institutional investors in this space, it's good to remember as we talk about Robinhood, the amount of retail investors who still hold Bitcoin, more so than institutional investors. So, but interesting to see, especially as we saw that some of the worries murmuring through regional banks, saw that uptick in Bitcoin and, as you mentioned, briefly crossing that 52,000 mark. Pretty remarkable at this point. Yeah. All right, well, speaking of, shares of Robinhood moving to the upside this morning after posting a surprise beat on profit. The stock trading platform reported adjusted earnings per share of 3 cents in the fourth quarter versus an expected loss of 1 cent a share. Revenue also beating. Robinhood seeing transaction-based revenue climb higher, driven primarily by crypto trading. For more on the results, we turn to John Todaro, Needham & Company Senior Research Analyst. Good to have you on the show here. So walk us through some of the expectations that we have for Robinhood, especially when you think about Coinbase and that sort of that hustle for getting that spot Bitcoin ETF proposal.
Yeah, sure. So Robinhood's actually in kind of a sweet spot where they also trade equities. So when you have these Bitcoin ETF launches on, I believe it was the first day that was launched, Robinhood added those to the platform. So they can trade the ETFs or they can trade the spot Bitcoin. What I think the concern was for a lot of investors was, do the Bitcoin ETFs cannibalize the Bitcoin trading business? And that concern is not only for Robinhood, but Coinbase. On the earnings call, that's not what played out. Robinhood management said that the Bitcoin ETF was additive to their Bitcoin trading business, that you didn't see the ETFs kind of take share away from their direct buying and trading of Bitcoin on the platform.
Yeah, John, looking at some of the transaction-based revenues, I mean, cryptocurrency, that was almost double the revenue that equities trading revenue saw here, where you saw the growth there move higher by about 10%. Well, it increased 8% year over year, primarily driven by cryptocurrencies. They mentioned that was up 10%. Equities revenue was up as well here. And so ultimately bringing in more revenue on the cryptocurrency front. How annexed is Robinhood's future growth profile to the broader crypto landscape and the ability for more users to be able to buy and trade or even just hodl?
Yeah, so 2024, most of the growth we see, we do have coming from crypto. Crypto came in very strong in December and primarily made that beat in Q4 there. So if it weren't for crypto, the transactional activity wouldn't have beat. So we do see that as kind of a growing segment. It's coming off a very low baseline. So crypto volumes obviously plummeted a lot last year. So you're seeing kind of a snapback that's really propelling the growth. Or equities options, that growth is a little bit more moderated. It's a more mature business for Robinhood. So we do see crypto as kind of the growth component for Robinhood. That being said, what we would like to see is Robinhood come out and offer more crypto products. They've done a good job. They've added a MetaMask integration but they still offer a lot fewer crypto assets for trading versus a platform like Coinbase or some of the other crypto native exchanges, if you will. But that being said, Robinhood has moved into Europe now, and so they're trying to grow that crypto presence internationally. The thinking being regulation is still a little bit tight in the U.S., and so that business, they're kind of keeping a little bit of a lid on it almost.
And John, also on the call, they talked about focusing on driving net deposits even higher by improving the user experience and the value proposition. How do they get there?
Yeah, that's so they have taken share from other brokerages. So that has been a positive for us if they can continue to grow that component. We do notice that the platform has improved quite a bit for that traditional kind of equity brokerage business. So that's a little bit more of a slugging match. You have to take market share. There's not necessarily a ton of new assets coming in. So it's a little bit more of a market share battle there versus that crypto component where you can just benefit by more retail investors moving into that landscape. So that one we do see is a little bit more moderated moving forward.
Gaining in terms of market share, but also the monthly active users, that actually was down 4% year over year. What type of kind of strategic play do you believe that Robinhood still has to deploy in order to make sure that they're building out that number and seeing growth reinitiated?
Yes, they've done a few product launches to try and increase that monthly active participation. So they rolled out 24-hour stock trading. I believe it's now up to 900 tickers that they offer 24-hour stock trading. So they have rolled out a number of products to try and get that increasing active user participation. What I would say is, if you look back to 2021 and 2022, at least the early part of 22, it was a very different environment. Even though stocks are kind of getting or back around all-time highs, that retail activity in the marketplace is still not what you saw in 2021. So when you do look back a year or 2 years, it's a tough comp, so to speak. So, they have been improving MAUs. But to get back to 2021 levels, if that's what we're looking at, I do think you're going to need to see a lot greater retail participation, not only in crypto, but also in stocks.
What type of inflows are you expecting or anticipating if we do see the Fed move up its rates cutting prospectus or pathway? I mean, especially considering we saw just yesterday what the reality of the number of traders or the number of investors that are willing to step away from certain portfolio plays if the Fed looks like they're going to just stay higher for longer and actually push out that rate cutting cycle even further.
Yeah, so if rates stay higher for longer, we do think that negatively impacts the trading business, Robinhood, Coinbase, all of these. So not only would that likely weigh on crypto prices and maybe even stock prices, but it also, especially on Robinhood, folks might sit in cash longer. They're earning, call it 5% or so on the Robinhood platform. So instead of putting those assets to work in trading, they might just continue to clip that yield. So we do, Robinhood's a little bit of a hedge business where you do have the interest income component of Robinhood, where higher rates that benefits that business, but then higher rates negatively impacts the transactional revenue. So it's a bit hedged, but what I would say is overall, Robinhood, Coinbase, they're going to benefit more by getting rate cuts. So if you do see cuts start to happen sooner, I think that's good for crypto prices, likely good for most equity prices, and then also good for just the participation in trading activity, especially on the retail side. So while that business is a bit hedged, I would say rate cuts sooner than expected, better for Robinhood.
And John, we know that Bitcoin enthusiasts or crypto enthusiasts are always looking for that next catalyst. We know we're supposed to get the Bitcoin halving coming up in April. How does that translate, though, into the inflows that Coin and Hood tend to see when they have this sort of rush and a lift in the price of crypto?
Yeah, sure. So the ETFs have so far been kind of a net win. We've seen continuous net inflows. The one outflow was the Grayscale GBTC product. A lot of that selling has slowed down. So now we're on a trajectory where you're just getting kind of day over day these net inflows to the Bitcoin ETFs. What happens there is folks can either trade the Bitcoin ETFs on Robinhood, so that's a benefit for Robinhood. And then on Coinbase, the institutional flows into these ETFs, a lot of the ETFs are transacting via Coinbase. So those institutional volumes are going through the Coinbase platform, if you will. So overall net positive, we think pushing Bitcoin past 50K has been in part due to these Bitcoin ETFs. So we do view them overall as a positive for Bitcoin. There was a little bit of a buy the rumor, sell the news when the ETFs first came about, but now we're kind of seeing those net inflows just continue to pick up. So that was a positive catalyst. The next one is the halving. It shouldn't be much of a surprise, right? A halving, everyone knows, happens every 4 years. So you would think the market bakes in some of this. But what the market might be missing is just kind of that daily demand that's going to outstrip the daily new supply that comes out after the halving because there's a supply crunch. And that could start to get things going a bit more. After that, the next catalyst for the space would be, as you guys mentioned earlier, whether you get an Ethereum ETF. And I believe the first deadline for that is in May with the SEC.
Well, looking forward to seeing how that plays out. Obviously, either a bit of a different animal here from a traditional token like a Bitcoin. Appreciate you taking the time, John Todaro. Thank you so much.
Thanks for having me.
We're watching stocks steadying after Tuesday's sell-off. We'll look ahead to more economic data on deck. That's next.
Stocks higher this morning after the hotter than expected inflation data sent the Dow to its lowest level in about a year. Well, not the lowest level, but one of the biggest declines that we've seen in about a year. What is the signal for the other economic data on tap this week? Thomas Simons, who is the Jefferies senior U.S. economist, joins us now. Thomas, great to have you here in studio with us. Why was everyone so surprised with this print, especially as we're just trying to make sure that a larger trend is locked in here?
Yeah, I mean, I think that for the last 6 months or so, most of the data and the news we've gotten on inflation has been generally kind of going in the right direction, right? And for a while, there's been this notion that the quote unquote last mile problem with inflation, kind of getting it down from a 3% annualized rate to 2 is going to be this big problem. Well, the data, especially as we saw it in Q4, was sort of arguing against that, right? It was saying that we were getting closer and closer. And it feels like yesterday's data was a retreat, right? It was a step back in that progress. The sort of nature of this hyper focus on inflation and how it has such strong implications for what the Fed is going to do, it's just like there's a lot of attention on it, right? It's going to move the markets. People get very skittish.
And this isn't the first time that, we've seen sort of some of these blips with inflation here, but then also when you factor in seasonality in January's report, it was surprising to see this strong of a reaction. And I believe we were chatting about, is it about the absence of other things to worry about, that people are just super honed in on this?
Yeah, and I think it's also the problem that a lot of the economic data in general has been very kind of difficult to reconcile with each other, right? Like there's a lot of inconsistencies across different series. So whether it's looking at something like the establishment survey and the household survey within the labor market data, or if it's the PPI versus the CPI versus the PCE deflator, it's all very, very noisy, right? So, I have to admit that I forgot exactly what the beginning of the question was with that, but like the seasonality, right? Yes. So I've seen this argument. I think that there is some validity to it, but also if it's coming in higher than other Januaries, that means that the seasonal impact was bigger this year, right? And that's meaningful, right? Because that does mean that there are still these wage push pressures that need to be, kind of delivered through to consumers, especially in the service sector.
Absolutely. And so that considered, where for the consumers right now are we able to kind of draw a through line to a few of these different data points that have come out to suggest where there's still resiliency and where consumption is still holding up?
Yeah, I mean, I think that it's mostly going to be concentrated amongst higher end consumers on the kind of discretionary side, and they're enough to kind of keep things floating, but not enough to drive big growth, right? Mm-hmm. And I think if we look at the components of, especially within the service sector of the CPI, where we saw a lot of this pressure, it's a lot of different industries that have very low productivity type jobs, no discretion in demand, right? Like, water and garbage service, for instance, like you don't have an opportunity to shop around to different providers of these things. So as a consumer, you're just a price taker on that, right? The lower end consumer is especially it's almost like increases in gasoline prices, right? Like you have to put it in your car to go to work. So when they see these service sector prices continuing to rise, it just, it really eats into their budgets for consumption for other things.
Especially when you think of the things that really hit home for people. Shelter, and of course, your car and being able to afford auto insurance there.
Right.
And I know some of that data that we're still waiting to see some of this auto insurance, the lag still catching up here. Mm-hmm. Are you surprised that it's still this sticky?
Somewhat, yeah. I mean, I wouldn't have thought, because it's been very sticky now for about 2 years. Like it's been almost like, over 20 months, it's been like increasing over 1% month over month. And I mean, on the one hand, it makes sense, right? You have high interest rates, so financing everything is high, is expensive. Even though car prices have come down in the last few months, they're still, in aggregate much higher than they were a while ago. You have capacity constraints on how much, maintenance is real, sort of services available, because people couldn't buy used cars to replace old cars, so they're repairing more and more old cars, right? So just the whole ecosystem is that much more expensive, and the insurers are dealing with, again, the high rates to finance themselves, and the claims are all more expensive, so that just has to get passed along to the consumer.
How does this all factor into the Fed and what the real number of cuts we may see is over the course of this year from your perspective?
So I think the issue with the Fed is that they're looking at this, the bones of inflation, and I think if they're honest with themselves, they have to say, how much are interest rate cuts really going to, or even to think about, would more hikes really like slow down these bits of inflation? And I have to imagine the answer is really no. Like, a lot of it is not particularly either economically sensitive or interest rate sensitive. So unfortunately, what I think it ends up doing is it puts the Fed in a position where they have to keep being patient, like kind of like what we saw with the meeting a few weeks ago.
How far out does that patience, you think, extend to?
I think, at least until June.
Yeah.
And even then, it's questionable whether or not they really have too much room to cut, barring some more significant slowdown in other economic data.
So given the reaction that we saw from the CPI data, we still have PPI on deck and retail sales as well. What are the expectations there?
So I think retail sales is the one where there's probably some underappreciated downside risk, right? Like within retail sales, and forgive me off the top of my head, I don't remember if there's 12 or 13 different categories, but 11 or 12 of them are goods related, right? It's only food services that is, kind of service related. And what we saw yesterday in the CPI data is the price of almost all goods is weaker, right? Nominal sales or retail sales is a nominal price level, not real inflation adjusted measure. So with prices being lower and lower, the idea that maybe people had to pull back a little bit after another strong holiday season, I think that we're very likely to see some more negative numbers. On top of that, we had a decline in unit auto sales. There just isn't much that leads me to believe that this month is going to be particularly good.
We'll continue to track those market moves when we get that reaction as well. Appreciate you joining us this morning. Thomas Simons, Jefferies senior U.S. economist. All right, well, we're looking ahead to NVIDIA earnings next week. Here's a look at what investors can expect.
NVIDIA is Wall Street's AI darling. The company's stock price is on a massive bull run, rocketing 380% since the end of 2022, and was the best performing component of the S&P 500 in 2023. With that said, here are 3 things we'll be watching for when the chip giant announces its fourth quarter earnings on February 21st. Artificial intelligence. NVIDIA is the tech industry's go-to provider for the powerful graphics processing units used to train and run generative AI models. Heck, Meta CEO Mark Zuckerberg announced that his company will purchase an incredible 350,000 NVIDIA H100 cards by the end of 2024 at a price tag well into the billions of dollars. Microsoft, Google, Amazon, Tesla, you name it, every company is clamoring for NVIDIA's chips. And those are just the tech giants. Smaller firms are also working to get their mitts on NVIDIA's offerings. And with the earnings season already showing continued AI investment across the tech industry, NVIDIA stands to continue to gain considerably. Market expectations. Expectations for NVIDIA's fourth quarter are sky high after the company stunned Wall Street in the prior period when revenue rocketed an incredible 206% year over year to $18.12 billion. In the fourth quarter, the company is projecting revenue of $20 billion plus or minus 2%, well above analysts' prior expectations of $17.8 billion. And Wall Street doesn't see the growth stopping anytime soon. Bank of America recently raised its price target in NVIDIA from $700 to $800. Goldman Sachs also raised its price target for the company to $800. It previously had a price target of $625 on the stock. Regulation and competition. Still, it's not all smooth sailing for NVIDIA. The company is contending with U.S. export restrictions, blocking the sale of some of its high-end chips to China, one of its largest markets. And while that isn't hurting the company for now, it could mean the chip giant misses out on potential future sales. Then there are rivals. AMD and Intel are slowly but surely building out their own high-powered AI chips, with AMD in particular gaining on NVIDIA's tail. That company says its latest MI300X chip can go toe-to-toe with NVIDIA's H100, a claim NVIDIA refuted via a blog post. Even NVIDIA's own customers, including Microsoft, Google, Amazon, and Tesla, are building out their own AI chips, which could cut into the total addressable market for third-party AI chips. Still, those threats are relatively distant at this point. NVIDIA is still riding high at the moment, and we'll find out if it can keep the hype train rolling when it reports its results February 21st.
Move your company out of Delaware before they lock the doors. That's what Elon Musk posted to his social media platform X. This comes as the Tesla CEO continues his campaign to reincorporate Tesla in Texas instead of Delaware. Now, 2 weeks ago, a Delaware judge invalidated the $56 billion compensation package that Musk earned as CEO of the EV company. Now, Musk then vowed to move immediately to hold a shareholder vote on Texas incorporation. The vote hasn't been scheduled, but if it is, what do Tesla investors need to know? Well, joining us now on this is John Coffey, Columbia Law School professor and director of the Center on Corporate Governance, and our very own legal reporter, Alexis Keenan. Big welcome to you here, John. So first, for people who are trying to get up to speed here, what is it that shareholders need to know when they're being asked about reincorporating in Texas?
Well, they need to know, first of all, that the CEO or the controlling shareholder may have interests different than their own, and Delaware will put them under some degree of scrutiny. Other jurisdictions like Nevada are advertising that there'll be very little judicial oversight, and that's what some CEOs want. Institutional investors, however, often hold the majority of the stock. The cases where we're seeing this kind of migration to the new jurisdiction are cases in which the controlling shareholder has the vote locked up. Either he owns 50% or he has de facto control because many shareholders do not vote, and a 40% block is actually a de facto controlling shareholder.
John, Alexis here. I'm curious to know if Musk, if he does want to, and if the company wants to put up a vote to the shareholders for an incorporation move to Texas, is he going to need a group of new independent board members in order to effectuate that, to kind of not run into the same problem that he ran into in the case over his pay?
Well, that is a good point. Now, there's just been this case involving TripAdvisors where the Delaware Chancery Court and Supreme Court decided not to interfere with the movement outside of Delaware. They don't want to look like they are locking you in. So if you come to Delaware, you can never get out. And they permitted TripAdvisors to move, even though TripAdvisors did have a controlling shareholder. I would advise someone in Mr. Musk's position to make sure the cosmetics look a lot better and that you have one or two more independent directors. But the Delaware courts did permit TripAdvisors to move out.
What is the likelihood of success for Musk in this move and the legal proceeding?
I think Musk has already determined he wants out of Delaware at all costs. He immediately moved Twitter out once he got control of that and turned it into a private company. Is he going to try first to get a new transaction approved? He could decide to do that, but I think Musk, ever since the Twitter case, wants out of Delaware for all his companies, and I don't think he'll let anything stop him if he can do it.
John, now there's a broader issue here, though, at play in that a controlling shareholder, if you argue that Musk is in fact a controlling shareholder in this instance, that they are electing the independent board members and therefore can, whether it's Delaware's court, whether it's another business court in another state, can those independent directors really protect the minority shareholders?
Well, I think the more that the directors are selected by the CEO, the lesser the likelihood that you'll get true independent scrutiny. Normally, we want an independent nominating committee of truly independent directors selecting the new members of the board. That's what you'll see in the large public corporations. But companies like Tesla and Twitter, well, they're used to having one charismatic controlling shareholder, and the shareholders may come in expecting that they are betting on the success of that shareholder. So there is less desire for independence.
And so, John, Delaware is, of course, the legal home to just over 2/3 of the Fortune 500 companies, and that's been increasing over the past 5 years. But when you look at the sort of protections that are offered in Delaware versus some of these special business courts in Nevada and Texas, what should people be aware of in terms of sort of how they're leaning towards some of these officers and directors in some states versus in Delaware?
Well, from the perspective of an independent person, what you know is companies often want Delaware because they can eliminate juries in any trial. All cases in Delaware involving corporations are going to be heard by judges only in the so-called Court of Chancery. That means you don't have the risk factor of a runaway juries. Juries can get the bit in their teeth and decide to make rulings that look against the weight of the evidence to others. All right. The new business courts may or may not be able to escape juries. That depends on what the state constitution says. But that does give you one residual advantage. And even if you set up a business court, they don't come to it with the century of jurisprudence history, the case law, and the answers to all questions already in their decided decisions. As Delaware gives you an elaborate body of law where you can predict the outcome based on the facts. That's not true if you establish a business court tomorrow, because in some states you may have less than a couple of dozen decisions about corporate law. The Delaware judiciary in this area is specialized in hearing corporation cases and not much else, but it makes them very expert in their field.
John, we're learning now through Reuters that both the parties, the shareholders in the pay dispute case and Tesla and its directors and Musk, that they are going to agree on doing a pause, a stay of the decision of the Delaware chancellor until this case is appealed to the Delaware Supreme Court. So can you just walk us through what that means for timeline for resolving that matter and what really has to happen next?
Well, the Delaware Supreme Court can move quickly. You see this in many takeover battles where it goes from the Chancery Court to the Supreme Court for an injunction and is resolved in a matter of weeks. This is not a case that has a background merger that's being delayed, so I don't think they'll rush quite as expeditiously. But you'll go up to the Delaware Supreme Court, which I think is going to be leaning in the direction of the chancellor. She wrote a very fact-specific 200-page decision making all kinds of findings of fact, and appellate courts generally don't like to reverse findings of fact because they weren't there, they didn't hear the trial, they didn't see the credibility of the witnesses, and thus some deference is given to an experienced trial judge. And the chancellor is the sort of senior member of the Chancery Court and is really respected within the nation's corporate law bar. So I think the odds on reversal are, at best, it's an outside shot. There may be a 20% chance that they would reverse the chancellor. They may change some of the language, however, and suggest they're a little bit more friendly towards executives and their compensation. But I would not predict that they would overturn the chancellor, and this could be resolved easily by the summer.
John Coffey and Alexis Keenan, thank you so much for taking the time here with this conversation. We're going to continue to track the developments as it plays out. We appreciate it.
Okay, thank you.
Thanks. We've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
We're tracking shares of Instacart falling this morning after missing revenue expectations in the fourth quarter. We're getting a broad look at the food sector this week as we get reports from food and beverage giants. Now, a common thread through the reports, inflation's impact on the consumer and subsequent price hikes from these companies. Here with more is Yahoo Finance's Brooke De Palma. Hey, Brooke.
Good morning, Rochelle. Good morning, Brad. I mean, certainly this is something that we're hearing across the board. Consumers simply buying less. Volume growth, seeing a bit of a decline here year over year for Instacart. But the amount of orders, well, it did see a slight uptick in Q4 2023, up 5% year over year. But that's half of what we saw in Instacart orders in Q4 of 2022, when we saw a growth of up 10%. And so essentially, while the amount of orders increased, they said especially around the holidays, once again, the average volume per an order decrease. And that's largely because the cost of food is higher. Consumers are adding less to their basket. They're really getting impacted by the last few years of higher food costs that we have seen. And the CFO saying on a call with investors that that's relatively stable now in terms of basket size. It's about 4 quarters in a row now where we're seeing a relatively stable basket size. But they did note that inflation is moderating, but inflation is largely still out of their control. And they did add new customers in 2023, the most since 2019. But analysts are wondering now, is this a sustainable growth model here for Instacart, especially in this macro environment where we're seeing consumer spending slow down? Some top concerns that an analyst I spoke to this morning has is that potential of food disinflation being a headwind for 2024, consumers adding less to their basket, but also food costing less, and that could put pressure on top line growth. In addition to that, promotional environment is going to intensify in 2024. We're already hearing for so many companies that incentives are increasing, and Instacart did mention this on the call, that they're incentivizing to drive customers to shop more frequently. In addition to that ad business, well, we want to see growth there. It wasn't a major lever, this analyst said, in the past few years, and that's something that Instacart has really turned profitable with.
And Brooke, while we have you, the lockup period for Instacart is about to expire. So what type of price action is being anticipated there as well?
Yeah, this analyst told me expect lots of volatility tomorrow. The lockup period does end for this IPO for Instacart on February 15th. But in addition to that, this is going to be a major indication of whether or not this is a growth company, whether or not the majority of growth has already passed them, or if they continue to expect growth for the company. But once again, something to keep out for is that layoff announcement. They announced a layoff of roughly 7%, adding that they're going to double down on their ad business, that Caper Carts. But it did take investors by surprise, especially because it just recently did IPO. We also heard that 3 executives are leaving. That also raised some questions and took investors by surprise there. And so it'll be really interesting to watch how this all plays out.
Yeah, absolutely. Brooke, thanks so much for joining us to break this down this morning. Appreciate it. All things Instacart here. Well, let's stay in the basket business. Kraft Heinz reporting a miss on the top line as the decline in sales volume outweighs price increases. Shares are down more than 5%. For more on what this signals about the consumer spending environment as the competitive landscape intensifies, let's get to Aaron Lash, Morningstar Director of Consumer Sector Equity Research here. Aaron, great to have you here on this. You know, just as we're reading through some of the highlights from this fourth quarter, net sales decreased 7%. Gross margin, that was a slight increase there, but ultimately here, you're taking a look at some of the other categories, net income down 14.6%. I mean, your read in on this quarter and ultimately what they need to do to kind of turn some of these weak spots around.
Yeah, on the top line, some of it is because of the fact that they were lapping a 53rd week in last year's period. So if you think about it on an organic basis, sales were down about 70 basis points in the fourth quarter. But yes, you're absolutely right. Volumes have been hurt by a pressured consumer. Consumers are being much more prudent as it relates to their purchases, and that's impacting some of Kraft Heinz's categories. As a result, we're seeing them continue to invest more as it pertains to research and development, so in terms of innovation and that which aligns with consumer trends, as well as marketing, making sure that consumers are aware of the products that are out there, while also increasing their distribution in terms of the channels where consumers are shopping. So think club, think dollar, That's incredibly important, and we expect that those investments will persist.
And Erin, we did see companies like Coca-Cola, while still seeing lower volumes, still seeing higher sales. Those price increases there, customers still loyal to the brand there, at least for now. Why do you think we're not seeing that with some of Kraft Heinz's offerings?
So Kraft Heinz did have higher prices in the quarter on lower volumes, but the volumes offset the price increases. So there is still price, and management is guiding for the fact that price is still going to be a positive contributor to their results going through this next year. Obviously, there's a basket of commodities that is decreasing, but there are still inflationary headwinds that Kraft Heinz and others throughout the space continue to face. For Kraft Heinz, they specifically called out tomatoes, sweeteners, labor, as well as transportation. And so all of those are putting upward pressure on their cost structure throughout the next several quarters. And that's not dissimilar from what we've heard from other consumer product companies. Kraft Heinz specifically called out the fact, that their categories can be more susceptible to individuals, consumers that are on SNAP benefits. And that has an outsized impact. You think Kraft mac and cheese being one of those particular categories that might be more susceptible to trade down relative to others throughout the grocery store because of that exposure.
What's the reality of if they lose market share in certain categories, as you see more of a trade down, especially if a consumer is in a category where they are and have been under more pressure for an extended period of time? What does that pathway towards regaining that market share on the other side look like?
Yeah, that's a great question. And I think that that's one of the things that's been weighing on shares for firms throughout this sector over the past year or so. What path will these firms take? Kraft Heinz has been very emphatic that they're going to continue to invest behind research and development, behind marketing, across price tiers to keep consumers within their brand families, and that they're reluctant to chase short-term market share gains by overly promoting. That's not to say that they won't promote. We are seeing promotional levels return to pre-COVID depth and breadth in a number of categories. But because of the data and analytics that they've been investing in, Kraft Heinz touts the fact that the return that they're getting from that promotional spending has actually improved. So they're being much more surgical in terms of their use of promotions, as opposed to being more broad-based and not getting the return from that. And so we expect that will continue. But, from our vantage point, continuing to invest behind product innovation not only keeps your products top of mind and in line with consumer trends, but also makes you a valued partner for retailers in terms of trying to assist retailers in terms of driving traffic into their stores and growing those basket sizes, which have come down across the board, and really trying to be a good steward and a good partner for retailers in terms of, and that when taken together should help them as it relates to stabilizing and or improving their market share positions in time.
And obviously, a lot of these products, household names internationally here. What are you seeing in terms of the international options available, especially when you think of the Middle East impact? And you mentioned, some of the sweetness commodities like sugar. What does the international picture look like in terms of the growth trajectory here for Kraft Heinz?
Yeah, for Kraft Heinz, it's a very interesting story. Obviously, international is a much smaller piece of their business, and they're attacking it a bit differently. Internationally, their focus has really been on growing their food service business as a way by which to unlock awareness and brand appeal to consumers, and then ultimately to expand within the retail channel to a much greater extent. You think of their portfolio in terms of condiments and sauces and flavorings, and that does appeal and is well suited for the food service channel. And so that's how they've been approaching that market. Emerging markets for them have been growing at a fairly rapid clip. And given the penetration or the white space opportunities that they have available, that's likely to persist for some time, at least in terms of driving outsized growth relative to developed markets, maybe not at the cadence that it has historically or more recently. But there is a number of opportunities that they have at their disposal as they seek to tailor their portfolio and get to know that local consumer through the food service channel.
Aaron, does this seem like a management team to you that is at all concerned about the impact of appetites lessening or waning as a result of the prominence of some of the GLP-1s or weight loss or obesity treatments and drugs that have a growth trajectory that is quite remarkable that we've seen come about over the past year?
Yeah, it's a question that kind of hits a number of firms throughout my list, not just Kraft Heinz, obviously. Hershey, Mondelez, they've all been getting similar questions, as you can likely expect. The reaction that we've gotten from management teams up to this point is that they haven't seen any impact yet. Kraft Heinz did not talk about it on the call this morning, but the overall sentiment has been there's been little to no volume impact, noticeable impact at this juncture. It's something they're watching. And because of the resources that these leading brands possess, we think that they're going to be able to tailor their product portfolio to appeal to a consumer that might be going down this path. They've obviously faced a number of similar stops and starts as it relates to various health trends over the last number of decades. And this hasn't been an impediment to their business across the CPG landscape. And we expect that this will prove similar going forward. So it's something that we're watching. It's something that we're paying attention to, but no impact as of yet.
Aaron, great to speak with you here today on all of things Kraft Heinz and the entire sector here. Aaron Lash, Morningstar Director of Consumer Sector Equity Research. Thanks so much.
Thank you.
We've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance. Food and beverage sectors are in focus this week as we get the latest read on how consumers are responding to inflation. In Coca-Cola and PepsiCo's latest quarterly results, the soft drink makers are seeing a drop in volume sold in North America thanks to ongoing price hikes. But overall consumer sentiment remains strong. For more on beverage trends and the overall health of the U.S. consumer, we're joined by Dwayne Stanford, who is the Beverage Digest editor and publisher. Dwayne, great to have you here with us this morning. I mean, if there's one common denominator that you're seeing in some of the reports that are coming out from these major consumer packaged goods and food and beverage companies, what would that be?
Right now, everyone's waiting to see exactly what happens with the consumer, how much consumers are pressured by the economy. We've got a real bifurcation between the top end of the spectrum on the income level and the lower end. The lower end is the one that would be most concerning. That's where you would start to have some impacts to either volume sales and also the ability to price, your beverages. So companies are, generally feeling optimistic about what's going to happen as the year progresses, but it's something that everyone's watching very closely.
And there's always this want to compare Pepsi with Coca-Cola. Pepsi obviously broader in the snack space versus the more pure play with beverages for Coca-Cola here. How do you think we should be looking at those two brands?
Yeah, I think that's something that people don't always quite grasp when they're looking at these companies. When they're on the store aisle, I mean, they're battling it out every single day, and the frontline workers are going at each other, tooth and nail. But when you look at the companies as a whole, they have, very different strategies. PepsiCo, a huge part of its business, half its business is in snacks, and that's a very profitable part of their business. So they're looking to always make sure they can maximize investments in the snack business. And so a lot of times what they're doing is balancing those investments with what they do on the beverage side. So that sometimes leads to decisions when it comes to how much share they're willing to try to take by lowering prices. On the Coke side, on the other hand, they are a beverage play. That's their primary. That is the category they compete in. And so they have just a very different investment profile. That's why you often see situations where, Coke is leading on share, PepsiCo is falling behind on share at times, and they're constantly trying to get that level right as it compares to snacks. So it's something to really keep in mind when you look at those two companies in terms of how they compete.
Yeah, spot on, Dwayne. And I'm sure many Americans consumed multiple snacks last week for the Super Bowl. I mean, myself included. Consumers right now, though, we're complaining that packaged goods they're getting smaller, and shrinkflation is real. And it certainly caught the attention of many Americans, including one of the Americans at the top of the totem pole, President Biden. Take a look at what he had to say about shrinkflation, and we'll get your reaction on the other side.
When buying snacks for the game, you might have noticed one thing. Sports drinks bottles are smaller. A bag of chips has fewer chips, but they're still charging it just as much. I've had enough of what they call shrinkflation. It's a ripoff.
So there's shrinkflation, and then there's perhaps another thread of the mind of profit-led inflation as well here. I mean, where do we kind of toss this one up? Where does it settle?
I mean, this is something that the food and beverage companies have dealt with going back, well over a decade, even during the Great Recession. PepsiCo, particularly because they have such a large snack business, which is typically a place where you're going to find more of that sort of pricing strategy and sort of instead of raising the price at the shelf, you take more out of the bag in order to equalize that and make it easier, especially for lower income consumers. That's something that they've had to contend with for some time. The backlash against that. We just came off a period of extreme pricing growth across all food and beverage. Beverages and snacks were included in that. That pricing is starting to subside. And companies, as part of their strategy, are going to use that as a mix. They're going to do it. They're not going to stop. It's really all about how do you communicate that and how do you make sure that you're not going too far at any given time to really turn those consumers against your brands.
And speaking of that, Dwayne, I want to talk about just a potential trend that you see for the year. There's always some, no pun intended, flavor of the month here. What do you see as being a top theme that some of these beverages, both alcoholic and non-alcoholic, will be leaning into?
Yeah, I mean, one of the things for carbonated soft drinks has been flavors. Flavors are, over-indexed with young consumers, Gen Z consumers, multicultural consumers. So that's really been a real important part of the industry. It's about a third of carbonated soft drink sales on a dollar basis in the U.S. Things like root beer, orange, lemon lime, root beer. So that's a pretty important trend. And of course, zero sugar is extremely important. The companies like Coca-Cola and PepsiCo are really leaning into their zero sugar cola products, and also turning most of their beverages, making sure that all of them have some sort of zero sugar offering for consumers who want that as an option. So those are two big things that we're seeing right now for sure.
I'm learning a lot about my co-host right now, Dwayne. She just slacked me and said she does not like root beer. I love root beer. Dwayne, we'll get your take on this perhaps next time we have you back on. Dwayne Stanford, Beverage Digest editor and publisher. Thanks so much for taking the time.
Good to be here.
That's all for us today. Akiko Fujita has you for the next hour. Stay tuned. You don't like root beer?
Tastes like toothpaste.
Oh my gosh. Oh my gosh. Bye.
Welcome to Yahoo Finance. It is 11 a.m. on the East Coast, 8 a.m. on the West. I'm Akiko Fujita, and here's what I'm watching. Lyft and Uber flexing growth and gross bookings as companies in the gig economy focus on profitability. With the future looking bright for the ride-sharing giants, we're going to take a look at the growth prospects ahead for gig companies. Markets in focus as stocks attempt to recover from today's big CPI sell-off. Is this just a bump in the road for investors? And bracing for history, Intuitive Machines vying to become the first commercial lunar lander to successfully make it to the moon. But how can investors cash in on the space race? We're going to discuss much more ahead on this show. But first, let's take a look at markets as we look at all three major indices 90 minutes into the trading day. A prettier picture than what we saw yesterday. Stocks clawing back after that big sell-off that was prompted by a hotter than expected CPI report. The Dow trading pretty flat right now. The S&P 500 up about 11 points and the Nasdaq up 46. One of the biggest movers on the day, Uber. That stock is up in a big way after announcing its first ever buyback, a stock buyback, $7 billion what we're looking at. We're going to be discussing that a little later in the show, but you see the stock up about 11.7% right now. And of course, we are watching Treasury yields after the move we saw yesterday on the economic data. Across the curve here, we are seeing declines. The 5-year yield at 4.27%, the 10-year yield at 4.29%, and the 30-year yield at 4.46%. Well, stocks coming back to life today after the January CPI report sparked a massive sell-off. The Dow seeing its worst day since March of 2023. Here now tracking the latest market moves is Yahoo Finance's Jared Blickery. Jared, a better picture today, at least so far in the day.
Yes, especially the small caps. And, not for the Dow, though. Dow is just barely trading to the downside. But take a look at the Russell 2000 here, up 1% today. Nice gain. But when you put it in the context of yesterday, which was the worst day since mid-22 for the index, still down 3%. A pretty big move there. And investors still reeling. As you were keen to mention, we saw a big jump in yields. That pressures stocks. We also saw a big jump in the dollar. Those two go hand in hand. But critically, not moving too much today. And usually the day after a big lopsided move to the downside, you do get a little bit of a pause. Question for investors being, will it continue, or are we going to see ourselves at record highs soon again? First, before I tackle that, let's take a look at the sector action. We have industrials in the lead today, followed by communication services and healthcare. Trading to the downside just a little bit, we have staples, energy, and consumer discretionary. And we want to check in on the Nasdaq 100 and taking a look at the mega caps. Split picture there. We got Apple down 1%, but Meta up 1.4%. NVIDIA, another record high. That's up 1%. But I want to get into some of the nitty-gritty stuff in the market going on. First, the 10-year T-note yield. This is at a multi-month high. This is a 3-month chart. I want investors and everybody to see that late last year, the everything rally, as I was talking about, that was predicated on downward trending interest rates. Right now we have the opposite, so just thinking about that. Also want to track the VIX, and here's an interesting way of looking at the market. This is a 6-month VIX chart. We got a spike yesterday, and I want to show you the market map for the VIX for the entire year. This is something that worked very well last year, so I'm presenting it again here. This is January through December. We see a big important turning point right here. Guess what that is? That's February 14th. That's when we tend to see seasonally strong VIX readings. When we see the VIX go up, that means stocks go down. And so that means we could face some headwinds going into the early part of March. And people tracking the S&P 500 are also seeing a very similar thing here with respect to their market map, which is just a different way of looking at the market. I want to close here with Bitcoin because we are seeing Bitcoin solidly above 50,000 for the first time in years, 51,591. Let me just quickly show you a 1-year chart, and that is from the lower left to the upper right. Crypto enthusiasts, you got to imagine, at least they're celebrating today.
Yeah, it's a nice chart to see if you're invested in crypto there. Jared Blickery, thanks so much for breaking down the move so far. Well, Treasury yields are easing, as Jared mentioned, following a surge on Tuesday after that January CPI report signaled inflation may be stickier than investors expected. Joining me now is Michael Darda, Roth MKM chief economist and macro strategist. Michael, it's good to talk to you today. We always expected this to be a bit of a bumpy road, right? If we're talking about the Fed's tightening cycle. What do you make of yesterday's sell-off? Was this just a bump in the road, or is this a sign of maybe some more things to come?
Thanks for having me on. Yes, certainly a bump in the road on the way to so-called immaculate disinflation. So that January CPI report was a bit of a shocker. And, there's a measure that the Fed pays attention to that they call super core inflation. So essentially that's just tracking non-energy services, excluding housing or shelter. And that number rose pretty rapidly, depending on which measure you look at, 0.7 or even 0.9 of a percentage point. So that is really not what the Fed wants to see. And on the back of a very strong non-farm payroll report just a few weeks ago, aided in pushing those rate cut expectations backward. And, we just heard Fed Chair Powell recently say March is probably not going to be the meeting for the first rate cut. And now you can see that markets have even priced out the cut in May, or have gone very far in doing so. And with equity markets having run like they've run late last year into this year, it doesn't take much if you disrupt the narrative to see a big dump like we did yesterday. So not super surprising in that context.
With that said, we are just talking about 1 month. January typically a little more volatile than some others. How do we put this in the context of the overall timeline for that rate cut? Does it change a whole lot for you?
Yeah, I mean, my sense was that the Fed was going to be pushing back on the expectations, both in terms of timing and magnitude for rate cuts. Within their framework, what they're really looking at in terms of, where future inflation is going is labor market slack. We haven't really seen much, if any, loosening recently there. In financial conditions, which have eased pretty dramatically on the back of this risk asset rally. So our sense was that the Fed was going to be pushing back anyway. So hotter or stronger data is just going to reinforce that. There's a risk to the business cycle in doing so. I mean, the Fed is very focused on realized or reported inflation. It does tend to lag the business cycle. And so there's a risk here that pushing back too far, the Fed then starts the process and the economy's already started to weaken pretty significantly. And then if they're behind the curve, that's when recessions tend to happen. So no one's really focused on that risk right now. The focus seems to be fears of overheating. But things could change fairly quickly. And I think we need to be aware of that given where equity valuations are. We're just absolutely priced for perfection here. So whether it's the business cycle risk on one tail or inflation and rate cutting risk on the other side, it's worth considering risks that are not priced into the market at this point. But our sense is that don't panic over one inflation reading. The Fed is more focused on the PCE inflation, which comes from a separate report. That's looked much better over the last 6-7 months, and we actually see the largest gap between core inflation readings from the CPI versus the PCE. A gap about 3 times the historical norm there. So, I wouldn't go too crazy with the interpretation on the CPI report, but it certainly, fed the higher for longer narrative in the last couple of days.
Yeah, with that said, the reaction yesterday to that CPI report points to just how jittery investors are right now on any indication of inflation, not necessarily pulling back at the rate that's broadly expected. What happens if the retail sales number tomorrow comes in stronger than expected? Are we likely to see a bigger move again in the markets?
For sure. I mean, just before we jumped on, I was looking at 3-year Fed policy rate expectations, and they've lifted by about 70 basis points since late last year. And that really traces out the move higher in the 10-year yield that you guys were just talking about. So if the retail sales figures come in hot, I mean, we're looking for a softer report, but they've surprised to the upside in the last few releases. If they come in hot on the back of this strong January inflation reading and the payrolls report that blew away expectations, then that just continues to feed this higher for longer narrative, further pricing out of the timing of rate cuts on the part of the Fed. Now you have some people talking about no rate cuts, the Fed potentially even raising rates again. So I think we're quite a ways away from that, but we'd be pushing further in the higher for longer direction if we get a hot retail sales report tomorrow, and probably more equity market volatility with these high valuations. The expectations are just incredibly high, especially for the leading sectors of the S&P 500 like tech and consumer discretionary. So it's not going to take much in terms of disrupting the narrative to see volatility here, in my opinion.
Yeah, no question about that. Michael, it's good to get your perspective today. Michael Darda, Roth MKM Chief Economist and Macro Strategist. Good to have you on.
Thanks for having me.
All your markets action ahead. Stay tuned. You're watching Yahoo Finance. Well, Uber shares are rallying this morning on the back of its first ever stock buyback. That news coming off of Lyft's encouraging quarterly results. Investors cheering on Uber's more consistent profitability as Lyft and Instacart trim costs to compete with industry rivals. With higher rates and inflation lingering, what is a signal for the increasingly competitive gig economy? Here to discuss is Mark Lehman, head of Citizens JMP Securities, along with Santosh Rao, Manhattan Venture Partners head of research. Good to have both of you on today. Santosh, let me start with you. Now that we've got Lyft and Uber's results out of the way, the big ride-hailing giants really pointing to a bit of a tailwind here when you think about growth in gross bookings as well as ridership. What's the big headline as you see it in the space?
I think the big headline is that they've turned the corner on profitability. They finally come of age, and now they're executing on all cylinders, like they say. So I think that's the big headline. Profitability was the big issue. I remember when we got in first pre-IPO, the whole issue was the sustainability of the model, the path to profitability. These were the two compelling questions at that time. People doubted whether they can survive, but I think they have done that. They've proven that more than enough, and they've turned the corner. So that's great numbers with Uber buying back, not only producing profits, but buying back shares and all that. So that's a healthy sign. The gig economy is up and running.
Santosh, to follow up there, though, when you think about these two companies, at its core, it is about the ride-hailing part, particularly with Lyft, even though Uber's diversified more. I'm looking at numbers from Uber, for example. The number of drivers on the platform up 30% year on year. How much of this is also about a tailwind they're getting from the economic environment? Maybe some people looking to add a little extra cash, that bringing on additional drivers.
Absolutely. That's a big part of this whole driver surge in drivers, demand for Uber and Lyft services, all these drivers coming on in the game. I think the big part is the middle class wages. Middle income wages are stagnating. That's a given. Maybe here and there, maybe they'll be improving, but overall, it's been stagnant. So the need for supplemental income is still big and growing. So I think that's a big part of people coming in and driving. And that also makes the case stronger for gig economy, for these drivers to stay independent. They want to do more than just one thing. So this whole push about regulatories and making them full-time employees as opposed to contractual, I think that's kind of a weak argument at this point, because these drivers want supplemental and they want to do many things, not just drive. So I think net, that's a big tailwind for them. The drivers are there now.
Mark, to what extent does that narrative translate over to the delivery space, specifically a name like DoorDash? What do you see as the big drivers?
Well, I think DoorDash...
Well, it's a combination.
Sorry, that was a question to Mark.
Okay,
sure. DoorDash reports tomorrow, so we'll be watching that. And as you probably know, Uber's at their analyst day today, and I think it translates into positives for the stocks you just mentioned. But there's a bigger shift going on, and I think we're in that kind of early innings of that. First of all, profitability obviously is now in the front, as opposed to saying that we're way down the road. And I think that's really important. Secondly, I think pricing is starting to increase. I think we're all seeing that. You know, you used to hop on the Lyft app or the Uber app, and you'd kind of be like, boy, that's a good deal. And I think those good deals are abating a little bit, which obviously is directly going to the bottom line. But DoorDash is another one of those prime beneficiaries where there was lots of competition that seems to have abated a little bit. Obviously, Uber Eats is a big competitor, but it's kind of a two-person race right now. And I think you're going to see that Dash's results when you see that tomorrow. But Andrew Boone, who's our analyst, has been pointing out something that else is really important, that we're moving away from buying things to some of these services that people are taking advantage of. So you're just seeing more people kind of getting in the Ubers and Lyfts and going out for their night out. And I'm seeing that certainly more and more. And I think that tailwind is not going to abate. And I think that's a direct benefit for the bottom line for these companies.
Mark, let me follow up on that point, because you mentioned specifically that you think the street's underestimating DoorDash's profitability in 2024. Looking at the stock right now, it's up about, roughly 19% on the year. How much more upside do you see there?
Clearly, with the stock moving as well as it has this year, and we've been recommending it for some time, they have to perform. And they're getting that beat and raise category. So they've done a great job. I think you're going to see that tomorrow. And I think that other point about 4 or 5 competitors now going down to 2 or 3 for most of the cities that DoorDash competes in is going to accelerate. They, like Uber, have done a much better job of monetizing and finding ways to find other ancillary ways to get revenues and benefits. And I think their name is the name in delivery. So they're in the beat and raise category right now. They just meet numbers. That's not going to be enough for this stock. But again, we expect that to continue. And their kind of growth, I think, will show that tomorrow when they report.
Santosh, there are still headwinds here in this space, one being higher insurance costs, which is flagged by both of these companies. You look at Lyft and Uber, but also today we've got a nationwide strike among Uber and Lyft drivers, as well as DoorDash delivery drivers. The concerns being about safety as well as wages. How significant is that headwind going to be for these gig economy companies moving forward?
Yeah, I think this headwind has been there for a while. It comes and goes in different forms. It will, I mean, the companies have to pay attention to that. Overall, I think they will manage that. I mean, that's an important part. We need this service. These services have become an intrinsic part of the transportation fabric of all the cities. So I think everybody knows that. So there is a need for that. So I think they will settle at some point. They need to maybe compromise. The costs will get pushed down. The insurance costs and all that will come down. You see the Uber rides and Lyft rides are slightly higher, not as cheap as before. The value proposition is not as compelling as before, but it's still the best option compared to the taxis out there. So I think net, I feel they will eat the cost. They will pass it down to the users, but they can manage it. I mean, the thing is, these strikes have been around, and I was listening to one former executive of one of these ride-sharing companies, and he said while he was there were strikes every other time in some form or the other, and they always negotiated and came to a settlement. So I think I expect that to happen again because it's too important for both sides to continue and do well.
Mark, do you agree with that this is kind of a manageable risk that will be a constant in terms of the pushback coming from the delivery drivers, at least in the case of DoorDash, with the higher wages as well as more benefits?
You know, I do. It's one of those situations where both sides have leverage, and that sounds oxymoronic, but I think they do, and I think there will be a solution. And we've been saying it here for some time here at Citizens about Meta and some of the other companies that have been held in front of Congress, et cetera, that the specter of regulation and the specter of these fears have been a lot worse than the actual. And every time Mark Zuckerberg got in front of Congress, stocks got worried, but instantaneously those stocks started to lift again afterwards. Because let's be clear, Congress has great appetite for showmanship and showing that they're on the side of regulation, and they have no appetite to actually do it. And I think there's somewhat of a parallel here, that you're going to have people having these one-day strikes, and I'm all in favor of safety, security, and people getting a fair wage. But there's plenty of room here. And I think the healthy margins that Dara and others are talking about for Uber at the Analyst Day today are going to show that there's plenty of upside. I mean, remember, Uber hit an all-time high today. DoorDash is far, far away from that all-time high in the hysteria of 2021. So there's room to grow here. And if they get that healthy EBITDA margins with some expense pressures from insurance and other and safety and security. And let's talk about one other thing that's not even in the mix here. The threat of autonomous vehicles that was clouding these stocks for so long, we don't even talk about it anymore. Okay, so yeah, we'll have some driverless vehicles on the road, and I'm sure there'll be some pushes to that. But we haven't even brought that up in the conversation today. Why? Because the threat of that was far worse than the actual. And I think that's a parallel with what you talk about regulation and insurance pricing.
Yeah, that's an interesting point, Mark. You think back to when Uber IPO, that was a big question about whether, in fact, that was the only path to profitability. Mark Lehman, head of Citizens JMP Securities, along with Santosh Rao, Manhattan Venture Partners, head of research. Good to have both of you on today. Really appreciate the time.
Thank you. Thanks for having me.
Thank you.
While Airbnb's recent earnings reports indicates a moderation in demand, the opportunity to jump into the short-term rental market hasn't necessarily run its course. So take a look at the top best places to invest in short-term rentals. Let's bring in our very own Danny Romero, who has a breakdown. And Danny, we should point out, Airbnb likes to say that it isn't always about users on their platform who are just trying to cash in on homes, that they buy just to rent out. But there is still a lot of opportunity for additional income here.
Yeah, most of these investors that are on the Airbnb platform are also investors that have multiple listings. They're, looking for other forms of income, whether that's for their retirement. But back to this study from AirDNA, this is the year of the short-term rentals. And what's really interesting from this AirDNA report is that it doesn't list the popular pandemic boom towns like Austin, Texas, Boise, Idaho, or even Phoenix, Arizona, which is a really telling sign that there's opportunity elsewhere. Well, let's take a look at the top 3 areas. At number 1, we have Columbus, Georgia, a town known for the longest whitewater course. AirDNA estimates a robust demand. The average daily rate is $178, and investors could gain about $29,000 in revenue. Now, the city does require permits for short-term rentals and certificate of occupancy. Second on the list is Ellsworth, Maine. The biggest advantage here is how close it is to Acadia National Park. It's a park that has scenic hikes and views. AirDNA estimates the average daily rate for this area to be $335, and investors could gain $41,000 in revenue. Lastly is Logan, Ohio, and the case there is to be made is that visitors can come and visit the area for the rugged valleys that it offers. AirDNA estimates that the average daily rate is $343, and investors could earn up to $57,000 in revenue. But it's important to note that Logan has strict zoning regulations and requires registration and licensing fees. Bottom line, as an investor and a visitor, do your research before going out to that area. Akiko?
$57,000 in revenue. It's not bad. Not
Yeah.
a bad return there. Danny Romero, thanks so much for breaking that down. Well, we are looking ahead to NVIDIA earnings next week. Here's a look at what investors can expect.
NVIDIA is Wall Street's AI darling. The company's stock price is on a massive bull run, rocketing 380% since the end of 2022, and was the best performing component of the S&P 500 in 2023. With that said, here are 3 things we'll be watching for when the chip giant announces its fourth quarter earnings on February 21st. Artificial intelligence. NVIDIA is the tech industry's go-to provider for the powerful graphics processing units used to train and run generative AI models. Heck, Meta CEO Mark Zuckerberg announced that his company will purchase an incredible 350,000 NVIDIA H100 cards by the end of 2024 at a price tag well into the billions of dollars. Microsoft, Google, Amazon, Tesla, you name it, every company is clamoring for NVIDIA's chips. And those are just the tech giants. Smaller firms are also working to get their mitts on NVIDIA's offerings. And with the earnings season already showing continued AI investment across the tech industry, NVIDIA stands to continue to gain considerably. Market expectations. Expectations for NVIDIA's fourth quarter are sky high after the company stunned Wall Street in the prior period when revenue rocketed an incredible 206% year over year to $18.12 billion. In the fourth quarter, the company is projecting revenue of $20 billion plus or minus 2%, well above analysts' prior expectations of $17.8 billion. And Wall Street doesn't see the growth stopping anytime soon. Bank of America recently raised its price target in NVIDIA from $700 to $800. Goldman Sachs also raised its price target for the company to $800. It previously had a price target of $625 on the stock. Regulation and competition. Still, it's not all smooth sailing for NVIDIA. The company is contending with U.S. export restrictions, blocking the sale of some of its high-end chips to China, one of its largest markets. And while that isn't hurting the company for now, it could mean the chip giant misses out on potential future sales. Then there are rivals. AMD and Intel are slowly but surely building out their own high-powered AI chips, with AMD in particular gaining on NVIDIA's tail. That company says its latest MI300X chip can go toe-to-toe with NVIDIA's H100, a claim NVIDIA refuted via a blog post. Even NVIDIA's own customers, including Microsoft, Google, Amazon, and Tesla, are building out their own AI chips, which could cut into the total addressable market for third-party AI chips. Still, those threats are relatively distant at this point. NVIDIA is still riding high at the moment, and we'll find out if it can keep the hype train rolling when it reports its results February 21st.
Well, the regional banking sector is having a tough start to 2024. The regional bank ETF, ticker KRE, falling around 10% this year on commercial real estate jitters. And now the mountain of loans on that real estate coming due is getting bigger. Here to tell us more is Yahoo Finance's David Hollerith. David.
Kiko, CRE was a worry for real estate and bank investors for much of last year. And those concerns of weakness have obviously become a little bit louder in recent weeks. Some of Wall Street's biggest names and also policymakers have addressed the issue. And what's going on here is there is about $929 billion in CRE loans that are set to expire this year. And that comes from the Mortgage Bankers Association. The unique thing there is that is 28% higher than what they initially had forecasted. So what's going on here is essentially how banks have been able to stave off CRE losses at this point, is that they've been able to push back or work out their loans with borrowers. And in many cases, this looks like a tried and true strategy that banks have used, just what's sort of known as pretend and extend. Now, the deal here is that they can continue to work out the same loans, either for some kind of add-on agreement or just by having the borrower pay the same amount of interest rate as they have been under the current loan that is past expiry. And this is obviously a point where, banks will lose money. They leave money on the table by not having borrowers refinance, but they obviously get to avoid and insulate their balance sheets in a way from having to mark down their loans and in a worst case scenario having to have borrower default. So that is in some ways why banks have been able to insulate themselves from these higher property value losses we've seen in sort of the commercial mortgage-backed securities market.
David, you mentioned pretend and extend. I mean, how long can banks continue to extend those loan expiration dates?
Yeah, that's the big question here. I mean, that's exactly what is happening this year, is that a lot of the loans that were supposed to expire last year have just been pushed back. And, the question is, how long can banks and their borrowers continue to push back these payments? And it really comes down to, where regulators stand on this. And from what we understand, as long as borrowers can continue to make their current payments, things are okay, and loans don't necessarily need to be marked down. But that comes down to the state of borrowers and the economy at large, and also which loans are coming due. So banks in general hold about half of the loans that are coming due this year. And of that total, as far as what those loans are tied to, 12% are to multifamily, about 25% maturing are to office space, and about 38% are to hotels. So it's really going to come down to how those borrowers' cash flow looks over the coming year.
Points to still a lot of uncertainty and jitters in the space. David Hollerith, as always, thanks so much. Well, higher interest rates have weighed on fintech stocks broadly this year, with growing concerns about consumer credit tightening. Our next guest, though, is initiating coverage on the sector with an overweight rating, saying there's still ample room for strong growth. Let's bring in Mark Palmer, Benchmark Managing Director and Senior Research Analyst, to discuss more. Mark, good to talk to you. Feels a bit like a contrarian play, but how much of this is about just positioning yourself for that rate cutting cycle?
Yes, thank you. Well, frankly, the fintech sector valuations are just out of whack with regard to the growth prospects of a lot of these companies. Now, I say that talking about those firms that aren't directly linked to credit, i.e. the neobanks or the online lenders, who continue to be vulnerable in our view. But if you look beyond that and look at those fintech companies that are actually well positioned to help consumers during a difficult time, and I'm talking about Block with its Cash App as an example, which acts as a bank account substitute at a time when traditional banks are raising the walls for new entrants, lower income consumers. That's value add, and we believe that that's sustainable. Now, we do expect that interest rates are going to be reduced over time. But with the hot CPI number we just saw, I think that's even in question. And there are other companies that we cover. Payoneer is a good example that could benefit from having lower or higher for longer interest rates, insofar as they have a significant amount of cash which is being invested, effectively float, that they are earning on. So I think this is a stock picker's sector, and there are good values to be had.
So let's break down some of those calls. You mentioned Block, certainly one that has scale when you think about their Cash App, Square, and then, of course, the buy now, pay later, Afterpay. What are the big levers that you see? Because you've got a pretty high premium to where it's trading right now in terms of your price target at $89 a share.
I think there are really two things to keep in mind when it comes to Block. One is that this is a company that, like many tech and fintech companies for years, has really just focused on the top line, growing the top line, getting as deep into their total addressable market as they could. In the current market, that just does not work. Investors are looking for profitability. They're looking for sustainability. They're looking for the ability to manage through a downturn, if that's in fact what we would see. And that comes down to whether a company is able to generate profits or not. Block has really pivoted toward a focus on profitability, really for the first time in its history. And the focus in particular on adjusted operating margin, getting that figure into the mid-20s by 2026, I think is going to be an important metric to follow going forward. And as the company makes progress toward that goal, we believe that the valuation of the firm and the stock should become fuller. Now, at the same time, we look at Cash App, which I mentioned earlier, as being a very timely offering in this market. And we think that the Cash App's growth, as measured in volume and ultimately revenue and profitability, is likely to grow apace, again, simply because it's the right product at the right time.
Finally, Mark, since we've got you, I've got to ask you about Bitcoin's moves. I mean, we're back to seeing it around $51,000. How do you make sense of the move, and how much more upside do you think there is right now?
Yes, well, we look at Bitcoin in this case, it's a big part of the Block story. Now, not from an operational standpoint or a fundamental standpoint, because it really doesn't affect the company's operations that much. But the reality is that Block is perceived to be a Bitcoin name. And the correlation between the price of Block and the price of Bitcoin is quite high, over 0.6. Now, what is coming up right now is what's known as the Bitcoin halving. This is when the rewards that are paid to miners are cut in half. This occurs every 4 years. What we have seen historically, there have been 3 halvings in the past, is that the price of Bitcoin tends to rally ahead of the halving and then for another year plus afterward. So we have seen that rally that has followed the historical pattern. There was a boost there because of the SEC's approval of spot Bitcoin ETFs, of course. But if the historical pattern holds, then the price of Bitcoin should continue to rally, and Block should benefit from that relationship.
Okay, we'll be watching it closely. Mark Palmer, Benchmark Managing Director and Senior Research Analyst. Appreciate you stopping by today.
Thank you.
Well, coming up, the space economy taking off. We're going to dig into how to incorporate the space market into your portfolio. That's coming up after the break. Well, SpaceX postponing the launch of Intuitive Machines' lunar lander today. Intuitive is vying to become the first commercial lander to make it to the moon and will hopefully take flight tomorrow. For how investors can cash into the space market, let's bring in Andrew Chanin, co-founder and CEO of Procure AM, here for our ETF report brought to you by Invesco QQQ. It's good to talk to you today. And of course, you've got an ETF around the space. UFO. I'm looking through your holdings right now, though, as we see the ETF overall off to a bit of a rough start here. How do you think investors should consider where the space opportunities are right now, given that a lot of these companies are still privately held?
Yeah, this fund was launched back in April of 2019. So we've seen companies added to the index. We've seen companies removed. We've seen mergers amongst companies in the index, as well as acquisitions of companies being taken private by private equity. And so we have seen a lot of changes over these almost 5 years of the fund's existence. The fund does rebalance and reconstitutes, and it looks for these new opportunities. But right now, so much of the growth of the overall space economy over the last several decades has really come from communications companies. And so that is a really important part of space that connects us here on Earth today. This interview wouldn't be happening if it wasn't because of space technology and satellite connectivity. And it helps us in so many ways today. But I think a lot of people are looking towards where the next areas of growth can be for space. And a lot of people are looking at still communications, as well as this emerging cislunar economy where this Intuitive Machines launch is something that we're looking to be able to expand as far as what's capable with the moon.
So let's talk a bit more about that, Andrew. I mean, you're talking about satellite companies. That's kind of where the big drivers have been in terms of where space exploration's been going. You've also got a name like Rocket Lab that's actually building out the rockets themselves that are heading to space. How do you think investors differentiate the two? And is the idea here to diversify your portfolio a bit to look at the beneficiaries as well as those who are helping those companies get them there?
Yes, so you do have some of the picks and shovels. You have hardware, you have software, you have enablers. What the index looks at is primarily it looks for companies that are deriving a majority of their revenues from space-related activities, businesses, and services. So what you're looking at is roughly 80% of the fund looks at these more pure play space companies, but also recognizing that some of the biggest players in the space industry are your prime contractors, your diversified aerospace and defense companies, but maybe not 50% or more of the revenues coming from that area. But the index looks for those diversified companies that are still making over 20% of their revenues from space, hundreds of millions a year in revenues from space. So there is kind of a balanced approach to investing in space, but with really a heavy focus on those that are more pure play.
Andrew, what about some of those more traditional aerospace players like a Lockheed Martin as well as Northrop Grumman? Where do you put that in your investment outlook when you think about the growth opportunities in the space industry?
Yeah, so up to 20% of the index at rebalance can be in these more diversified names. We have names like Lockheed and Raytheon and Boeing and Airbus. And they are already major players in space. Many people aren't that familiar that there's a joint venture between Lockheed and Boeing called the United Launch Alliance, which also helps participate in launch. And we certainly hope to see more companies come public in the space industry. But a lot of times these prime players, these diversified players, are beneficiaries of being able to pick up other space-related technologies. And we certainly hope to see that as time progresses, that they'll have a bigger footprint as far as a percentage of their overall revenues coming from space. And kind of looking at how governments, militaries around the world are looking at space, it's pretty much consensus that space is viewed as the new strategic high ground for military and warfare. So being on the defense side of the spectrum means that space is something that they have to have some type of exposure to as those companies evolve themselves.
Finally, Andrew, there's so much attention being placed on getting to the moon. You know, we have seen Astrobotic not necessarily successful with their commercial lander. We're talking about Intuitive now. There's many other launches scheduled this year for lunar landers specifically. Who stands to benefit the most on the back of a successful landing there? And as an investor, how can you position yourself for that?
Well, certainly, hopefully, humanity benefits from successful lunar landings, and as far as what we can accomplish as a species. But certainly, launch companies that are helping send these crafts to the moon, the companies that are developing hardware and software that's utilized on these missions. So much of this early stage, even this specific Intuitive mission, they're looking to pave the ground for future lunar landings. So providing analytics of how moon dust looks like when a lander actually approaches one of these craters, being able to put down beacons so that we can use have better navigation and communications capabilities on the moon. So we're actually hoping to lay down some of this infrastructure that will benefit future lunar missions as well. So just certainly these companies hope to be successful and see all their experiments work. But this would be a tremendous milestone for a commercial lunar landing. It's been since the 70s that the U.S. has sent a lunar landing successful mission, and very few countries have been successful in a soft landing on the moon. Period. So for a commercial company from the U.S. to be able to achieve that, I think is something that people around the world will be watching.
Andrew Chanin, co-founder and CEO of Procure AM. Good to talk to you today. Appreciate the time.
Thank you.
All your markets action ahead. Stay tuned. You're watching Yahoo Finance. Electricity prices rising in January, remaining sticky despite the overall cost of energy coming down. Here with the details on what's driving this move, let's bring in Yahoo Finance's Inez Ferre. Inez, what's behind the sticker shock?
Yeah, that's right, Akiko. And we saw electricity prices, as you mentioned, go up in January. In fact, for the last 6 months, they have been going up. And on a year-over-year basis, they're up 3.8%. So in fact, when all the other components in the energy index were down on a year-over-year basis, electricity was the only one up. Now, a large part of the electricity in the U.S. is made from natural gas. And we saw what happened with natural gas prices. From 2022 to 2023, they were down down 50%. Did your electricity bill go down 50%? I didn't think so. Part of this is because of the fixed costs which utility companies have. These are costs that are related to maintenance of generators. These are costs that are related to land. These are costs that are related to delivery. Also, investments in renewables, new transmission lines that have to receive renewable energies. All of these are costs which are going up for companies, and those are being passed on to the consumer. Now, the utility industry is highly regulated. PG&E in California had to go ask for approval in order to hike rates out in California, Kiko, and those rates were hiked this year by 13%. They did receive that approval, and part of the money that they are recouping from that hike is in order to bury their lines after those wildfires out in California. Now, some good news. The EIA says that this year, electricity prices on average are set to decline by 1%. That's on average. That means in some parts of the country, you will still see electricity prices going up. In other parts, you will see rates going down, but on average, down 1%. Look, I spoke to one energy expert that told it to me this way. Sure, you may see prices decline by 1% in 1 year, but then they go up by 8% the next year. That's an anomaly, really, when it comes to the steep climb with electricity. Akiko?
Okay, a lot of people looking at their bills after this segment. Inez Ferre, as always, thanks so much for that.
Thank you.
Let's do a final check of the markets as we head into the noon Eastern hour. A calmer day today in stocks, but still the Dow trading pretty flat right now. The S&P 500 up 14 and the Nasdaq up 73. We are seeing sectors here with industrials seeing the biggest gains so far in this session. That does it for me in the 11 a.m. Eastern hour. We've got much more to come here on Yahoo Finance Live. Keep it right here.